Under both these concepts, create competing entries, record cash transactions. Algorithm special. Dominantly book is is probably the most important thing to do that every transaction is recorded twice. The two entries to record the two aspects as the ledger and ledger account. The entries record two aspects as transactions are recorded in ledger account. The ledger is a book that contains the ledger account. Transactions are recorded in ledger account. An account is the history of all transactions in the ledger. An account separates what is received from what is paid. The cash account and bank account. Account has a left side known as debit side and right side known as credit side. Cash account. The cash account records cash received and cash flow. The left hand side of the account is called as debit side and used to record cash into the account. The right side of the account is called the credit side and used to record the cash flow. Business point of view. Bookkeeping or accounting treats business as gross income. Therefore, all transactions are recorded from the point of view of business, not from those of its customers and suppliers. Take every entry and enter the name of another account in the postings. Entries in ledger accounts are known as postings. Users are set to post transactions with us. Always remember to keep track of the debit and credit and include the correct coding sign, currency sign. Golden rule. The most important thing is to remove the for every debit entry, here and double entry bookkeeping credit transactions. This lesson we learn everything about recording transactions in credit transaction versus debit account, how to record credit transaction, discounts, trade versus cash system versus system, completing entries, all together in business and practice session. Credit transactions. Credit transactions take place without any being paid, without any being paid or received at the time. No entries to record payment or receipt payment and payment is paid off. Credit sale and accounts receivable. Remember to record all transactions from the point of view not from those of its customers. In a seller's book, a sale of credit to sales account and credit to an account of money. In accounting, someone who owns the money, business money is known as a fraud. When the customer or a top place, their account is created as a bank account. Credit purchase and accounts payable. The customers book a purchase credit is a free to purchase account credit to an account. In accounting, someone to whom the business owes money is known as a creditor. When the supplier is closed, their account is credited to the bank account. Trade discount. Trade discount is an allowance given to one trader to another. It is a reduction in the selling price of goods to one trader to another. This type of discount is only given when the buyer and seller are the same. Transactions are recorded only at the reduced prices of the net amount after discount. Trade discount is never recorded in the reverse. Cash or settlement discount. Cash and settlement discount is allowance for prompt payment. That is, if someone needs a payment before the stipulated time, the allowance is made to encourage such payments. Cash discount can be allowed as received. Cash discounts are always recorded in the purchase returns. Purchase returns always go to purchase returns account. They are never entered on the credit side of the purchase. Sales returns. Sales returns always go to a sales return account. They are never entered on the debit side of the sales. Accounting assumptions, principles, conventions, and concepts. In this lesson, we learn everything about GAAP, generally accepted accounting principles. The most important rules: duality, the pattern, business entity, realization, materiality, matching principle, prudence, money measurement, historic cost, consistency, going concern, substance over form. Identify and add together, we discuss and practice questions based on these concepts from exams. Accounting principles. Accounting principles are sometimes referred to as concepts and conventions. The concept is able to set down how the financial activities of business are recorded. The convention is an acceptable method by which the rule is applied to business. Business entity. Business entity. The business entity principle is also known as the accounting principle. This means that the business is treated as one of the principal components of the business. The personal assets of the owner, the personal spending of the owner, etc., do not appear in the accounting records. The accounting records relate only to the business and record the assets of the business, the liabilities of the business, the money spent by the business, and so on. Everything is recorded from the viewpoint of business. If there is a transaction concerning both the business and its owner, then it is recorded in the accounting records of the business. When the owner introduces capital into the business, it is credited to the capital The capital account shows a credit balance representing the amount owed to the principal. The owner will drawings from the business. A debit entry will be made in the drawings book to show the value owed to them, which reduces the amount owed to the principal. Consistency. There are some areas of accounting where the choice of method is available. For example, there are several depreciation calculated in the section of example. Where a choice of method is available, the one with the most realistic outcome should be selected. Once a method has been selected, the method must be used consistently. This is known as consistency principle. If this is not done, the comparison of the financial release will be difficult and the profit of monetary and debt is not done. There may be good reason why it is necessary to change the organization, such as insufficient reality. Principle of reality is also referred to as double as every transaction has to occur within the term double entry is to describe how this process is going concern. The accounting records of business always maintained on the basis of the business. This means that it is assumed that the business is conducted properly and time, and that there is an intention, there is no intention to hold the business. This is the going concern. Discontinuity means that the non-current amount shown in the same financial position which is the original cost has been suspended the period of cost. It is expected that the business will cease to operate in the future. The asset value in the statement of financial position. Assets will be shown at the expected sales value. Historical. The historical principles require that all assets and liabilities are used in model is closely linked to the money management. Cost is an impact and applying this principle is typical to compliance branches occurring at different times because of their different. Sometimes it is necessary to add up with more prudent or ensure that the current assets are more used. So the cost price matching principle is also referred to as calculation. Calculation of the revenue. The revenue of the accounting period is not against the cost of the same period of the the figure shown in income statement must relate to the period of time covered by this. There are not included in the same period. This means there is no combined can sales and so on from year to year. Material input. Utility principle applies to items of daily use and items which are not commodity. Other principles can be recording sector and for example, if I have a calculated purchase profits strictly in one part of its value is lost to no profits. The cost of calculating this and recording this easy more than the cost of transaction. Instead of the calculator being the cost of non-current expenses, rather than non what is material for purchase may not be so for the laptop of rather than large potential. Principle is possible. Large business we decide that non-current expenses is less than rather than charge. Small business may have zero. This principle is also being rather than having individual requirements of materiality is also applied in does not rely on personal ability. There are many aspects of business that not appear in the account. However, the trading force all their not appear in the account. Value cannot be expressed in the at a long level for us. The first principle is also known as the principle of this principle ensures that the however the excess of the on the delivery in short, prudence does not control the assets. Accountant should ensure that profits and assets are not outstripping the liabilities. Waste never anticipated profit. the realization that the profit is all through psychology, industry after right? The principle of good and realization is another important concept of this means that the revenue who has an obligation value to pay profit. And an order is placed by customer question profit. The profit is regarded as freedom, sacrifice. The same substance or not. These words are used to describe the profit. A machine for the manufacturing of the purchase of best the seller very clear position is the legal position where the machinery that have not been bought out of the system from an accounting point of view and for all practical purposes. The machine is no different from the other machine. This is the substance of the man. The practical view is to refer to the legal view. The accounting view. This is the substance. Balancing accounts. This lesson will learn everything about how to find and about a balance finance, what debit balance is, what credit balance is, discount column value. Practice lesson. This one. Why accounts? Some during the training period, all the accounts guaranteed balance period now. Similarly, the regular accounts are balanced now. Also, now the board account but how to balance that? Add each side of the account of each one to the insert on the same inserts or levels balance. Insert the total on this side of the account and carry the balance on to the other side of the account. Balance burden and balance and the balance is carried on account should always be shown as brought down on the accounts and the dates are important and so one should always include the balance carried on C bar D or brought down. In most cases, balance C bar D and balance D bar D is accepted. However, do not just write only C bar D and when more accounts balance. The balance to review balance is always included in accounts. Accounts of customers supply the balance practices. The state accounts the profits of the students and customers and asking the customers to make the difference in the account. And then sometimes many difference can happen from the two and three. And when we reach to the customer, instead sounds for the customer to the option providers. The other accounts are managed as a log entry with the classification of accounts and division of the In this lesson, we learn everything about the accounts are either personal or impersonal. The impersonal are either real or not. Ledger contains the transactions. All together, we discuss and practice the classification of accounts. All accounts fall into one of two classes: personal account or impersonal. Each of these classes can be further divided into personal accounts. Account for trade receipts. The customer owns the business. Their accounts have debit balance. All the debit balances for all customers are added to the accounts for trade receipts. Persons to whom the business owes the money. Their accounts have trade balance. And all the trade balances for all the suppliers are added to the business of those trade. The owner's capital and one personal account. All accounts other than personal account. Asset accounts. Real accounts are things that the business owns. It is important to say that asset is not something owned by the business or owned to the business. Remember to state both aspects of owned and owned. Accounts are further divided into non-current assets and current. Non-current assets are things that are acquired for business and not for business. These assets are intended to be used in business for a number of years. Consider on non-current assets capital. This includes such things as current assets arise in the course of trading such as inventories, cash, and balances. Personal accounts, expense accounts, which are things such as rent payable, wages, salaries, rent associated with the station. This type of expenditure is revenue. The costs incurred in running the business on a daily basis. These accounts are under the revenue accounts are accounts with trade balance. These accounts record the revenue of the business, receipts and income, such as rent receipts, depreciations, and interest. Caution: capital expenditure was types of accounts. This is the cost of purchase. The cost of running the business. will always try to capture the picture of the student life. Even if the picture on the other hand is not perfect, but student life. Division of the ledger or categorization. This is a very small division in the accounting principles. The ability to divide the amount into several ledgers. For instance, ledger for accounting expenses, ledger for general or non-general accounting expenses, private ledger for accounting confidential expenses like cash containing cash and cash equivalents, cash and bank accounts, petty cash and for minor items. Need for division of ledger. Division of ledger has this like usually consists the work is divided into several ledgers. Not all need to be done at the same time. Only private ledger is done simultaneously. Perhaps most importantly, division also helps to set the basis for credit risk accounting. statements about your limits. This lesson will learn everything about preparation of from trial and the concept of language, written conception, income account special accounts, group of the value. Are we can discuss on that special how to prepare and prepare trial, all major accounts, transfer the balance sheet account, the transfer the balance sheet, and question opposite, prepare the trading session, trading session, and the balance sheet is how to prepare the trading section of the statement. Similarly, we can address both of these in the last or selling the trading section cost of the rest of the income stream. Some key points to remember of the income statement is comparing the display the performance start always state the day when it is part of the definitive model and plan sales versus the words cost of sales are words gross profit are the gross profit is the cost of sales other expenses are taken into account. How to prepare an income statement, right? The income statement paid by people who sell their businesses any other income should always be added to the account. Particular order is it is now always to place the larger. But also profit for the trader formatting parts driven. First, you learn revenue. So that is adding income and income statement changing particulars. So you show the details for non-revenue less than your net revenue. So from that you have to get sometimes each particular not is not capital part. Also less for style. So trade costs. So you have some other income, you have to add other income. So gross profit plus discount receipt expense, other income minus net profit, gross profit, other income, discount receipt, rates, so we need to gross profit. So other income consideration is to reserve consumption inflation, the dating section and the profit. Statement of financial statement of financial that the statement of financial not other than financial statement, income statement and debit financial statement for debit key item trial balance and clear the set of financial trading section of the income statement. Trading section is done. stop at the start of the year. The formula for calculating cost of sales is cost of sales equal to net purchase. The purchases figure represents the total cost of sales and it carries over and paid on those purchases directly. The purchases the cost of goods are paid. The goods taken to the not only the cost of the formula for calculating purchase purchase carrying cost goods for own use. Trading account format is the format of trading. Profit and loss section. So profit and loss section is the profit and loss. Sometimes you can another is the profit and loss. So you have to start with cost add and take it all into unit profit. Horizontal format which is very similar to profit and loss. The horizontal format is not let me say the profit or the target or targets of the loss of the compared to compared to and the test of the techniques of the company insurance company travel education and better than how the how the government has themselves get wrong and just get the how the process a statement of fact. It is the account of management. Translate the concept of transfer into business by a high section first asset and allocate special items considered the root of the problem. All concepts discussed in practice section. Format of statement of fact. So example for this is current then capital and liability. Statement of non-current liabilities, current liabilities. Total. So total assets is equal to total liabilities. Statement of financial is equal to learn it one. Very important. So then given class by one. First we have part one that is non-current assets. So non-current assets first we have to display the tangible assets first. So then we have to show the other assets like office. So again you have to display the cost and this for non-current, non-current, current assets. Current assets we have capital, capital analysis, capital analysis, capital, capital, starting with capital, math or closing capital, non-current assets, non-current assets, non-current assets, like the statement, closing capital, and current liabilities. So total liabilities, statement of financial, of financial, transaction organization, statement of financial, statement of financial position can provide unlike an income statement, the statement of financial position does not follow the other principles. After the announcement of a balance sheet, the balance sheet then the balance sheet the statement of financial statement of long-term statement of the statement of cash. My important terms in each statement of non-current these are items which are consistent. Second component of current assets, the right cash, current liabilities. Here are weightage non-current liabilities as well as per the date of that non-current assets because the assets which are necessary on the order of the land current assets. These are in order in the cash. The order is sometimes used for the order of liquid asset is not used in the form of provision and inventory is not used for trade assets. Example, calculation the value of the balance sheet of last or by non-current liabilities. These are liabilities of this not bank current liabilities. These are liabilities of this non-current assets. Assets are liabilities. suspense efforts. How to start an study? I will first like code example. Repeat, repeat, repeat until you understand. Practice and practice. Simulate exam predictions and practice. Specifically learn everything about how purpose of correct errors, how to prevent the how to prevent the identify and practice communication. Not regular translation. Correction of errors. Thus, recording of the repeated transitions. Errors which are not shown by transition. System errors which can be which are not shown by transition. Error of correction. Error of such errors are discovered. They should be corrected. Of course, data analytics, like everyone saying about it, that everybody is talking about it, about it, that packaging solutions, like solutions, business data analytics also follows this concept of that. How to add international accounting. how to start and have a bird's eye view of it and study for both exams. The main takeaway is that practice, practice, even the examination happens. This lesson we learn in what is external then there is part external the realization are needed as organizations teachers and parents function for decision cost of this the cost of living on the partnership allows introduction and better skills. Now the starting points can have a very self focus on skills to repeat to fully understand practice and application. Practice simulating application and practice. Let's learn more about partnerships. Contents of management accounting contains meetings, non-monetary activities. It is effective in trying to implement best practices and implement improvements. The process of management contains 4 layers of control. This includes technical accounting, contents of management, input of capital expenditure, monthly budget, how provision assets are used, profit consolidation, and conclusion. start and finish that. Have a bird's eye view of the entire syllabus. Instead of work out example questions, take this time. Practice examples like 40 times and examinations practice and this lesson we learn everything about how to handle these questions to make it work about how to adjust preference of the dashboard to analyze the pieces of the special cases, identify and practice questions, bank statement. Bank is an statement of revenue and interest from bank. Ignore these. This is similar to the statement of body. Bank statement is a popular questions from most of the bank. It is a record of transaction. When money is paid into the bank, the customer account, this is the amount of the bank deposited in the customer's account. Positive bank balance will be the hold on balance in the paid bills. Comparing cash flow with bank statement. This is the bank statement to compare. The cash flow, it will be found in recorded along with the bank account is a record of the transaction. This will be money paid in the bank statement. Bank is a record of this paid accounts. It is important to compare the bank statement and the bank account. If the two balances agree, disagree, it is necessary to reconcile them with the opposite side. It is in the bank column of the bank from the account they are recorded. Also, compare the bank statement with the bank statement and the bank account and the bank statement. The two records will be there. Suppose the price is there, the this is the not record is written attached to the I will check this whether it is not in the that's it has to get the but it does not appear in the bank statement. Check cost will be again not check it in bank or not the GST amount only. These are a cash entry type paid in the bank and enter on the bank not appear in the bank statement. Evidence proof of the money paid by what the customers pay. Items not recorded. So it often happens that the business records certain items until the bank statement reports. If bank charges are met, the bank will definitely reimburse the customers amount without for any interest charge on the total amount of fees. It is not a check. Check will be paid in the bank even for the remaining fees and interest. Amount paid directly. These are paid transfers happening to the bank from directly to the business. 4. Amounts paid directly to the bank. These include credit transfers and account transfers. When banks pay directly to account holders, account holders. Differences in mistake. This is a difference. Records may be vastly mistake and errors may occur even in the same bank account. The differences between the bank account and cash and the bank statement as follows. List of accounts. This is the bank cash and bank statement. Suppose cash is not used. That's clear. Items in bank statement but not included. Bank charges and bank returns, deductions, standing orders, money transfers, and figures of bank statement details. Stages of bank accounts. Compare the bank account with the bank cash with the bank statement. So that the bank account is a comparison with the bank statement. Page of the bank account and deduction accounts. Update it again for the amounts paid into the business records. Stages of bank reconciliation. Update the cash book entry in the column where the figure was updated in the bank statement. Mark the figure in the credit items. Debit in the bank statement for the bank service rate transfer to the credit on the cash. Items paid from bank statement like outgoing taxes and direct expenses and debit in the bank cash. Stages 1. Correct any errors in the cash book. Balance the cash book with the error balance. Balance the correct cash book. If it is the end of the transaction, it will be the balance. start with balances. Okay, the balance of that is good balance. So you add unpredicted checks. Checks issued not predicted public. So they detect items not credited or cancelled. So that you do balances the balance. So the other way, balance. You start with balances for taxes. Less you have to detect unpredicted checks. Checks issued not predicted public. Add items not credited in balance. That you do balance. Okay. Irrecoverable and output is how to start a new study. Now we have a bird's eye view of the entire syllabus. Study each topic. Study workout examples, illustrations, and assessments. Repeat, repeat, repeat until you understand. Practice exam questions. Practice mock exams. Document solutions and practice. This lesson we learn everything about what is the development, what is the what is what, how to account for it. So altogether we discuss and practice questions. We identify and report exam style questions and including adjustments of irregular and outputs to exam question. Like goods are sold on credit, the customer is allowed to pay for the number. It is always a the customer is not pay for the and irregularity is an amount of the credit customer is paid for the customer and the wrong for the customer. All reasonable steps of payment to pay the debt. The amount of the customer is paid to transfer from the at the end of the year, the total of the income tax amount is transferred to the administration. That is the writing off. Writing off the paper is an example of the application of the principle of publicity. It cannot be considered so that the assets are not overstated. The amount of the paper that is regarding the cost of the business is constant. Otherwise, the profit for the recovery of that is that is the debt written off will be recovered if the credit customer pays. provided but it is identified clear estimation not to make a provision for it the amount of provision period will be established estimating on the past considering the length of the term provision of 90% normally creating a provision for the constitution the increase as a existing a provision for maintain the provision provision rather than the increase as the provision for transfer the difference of provision to the state income tax the balance the new provision how to calculate the amount for provision calculation of the provision for the certificates of provision specific and specific certain dates are selected for the specific the provision the amount of provision is reduced on the how to calculate the amount of depreciation for the specific provision must always be deducted from the in other words specific provision is defined and specified in the there may be doubtful debts specified as such. Generally, the provision is calculated as a percentage of total debt. Average percentage of debt among the total specific and general. The provision is made up to the debts that are not to be doubtful plus percentage of debt. Irrecoverable versus irrecoverable debts are never provided for. They should always be recognized. Irrecoverable debts recovered. Debt has been debt that has been written off as recovered must be recovered. The customer becomes able to get the debt must be recovered. The customer account will be included in the recovered debts. Recovered amount will be the amount received from customer will be the balance on recovered debt recovered amount will be again the should be shown under gross profit as part of the and should be added to the gross profit. Alternate treatment of recovered debts. Sometimes only the difference in the balance is amount and recovered debts recovered amount. The net difference is an expense that is included in the net difference is created. In this lesson, we learn everything about cash basis versus accruals, the concept and practical application of the math, how to record accruals and repayments in ledger accounts, how to adjust trial balances for accruals and effect on income statement and statement of financial position, inventories of consumables, two-way account versus statement, identify altogether we discuss and practice questions for these concepts. Example, income statements and statements of financial position, including accruals and repayments examinations. Cash basis versus accruals. Cash basis transactions are recorded as an cash is received and paid, matching concept and less to levels. In accrual basis, transactions are recorded considering the matching concept. Payment is an expense but is following when the transaction is recorded even year end is. It is often necessary to make adjustments to the accounting records in order to present a more accurate profit or loss. Such adjustments are referred to as year-end. It is common to find expenses that are not paid or that expenses are paid in one financial year but relate to other financial years. Only items relating to that particular time period should be included in the statement. The timing of the actual receipts and payments is not allowed. An income statement is prepared for a given period of time. The period of time covered by the statement being included as part of the statement. How to record inventory of stores on expense accounts. Some expense accounts represent inventories of consumables. Examples are stationery, heating fuel, and inventories of consumable stores will be reviewed at the end. According to the maximum concept, these inventories should not be charged in profit accounting. They are an asset and not an expense or at the end. Carry them down as a debit balance. This may result in an expense account having debit balance and credit balance in the end. In the statement of financial position, the inventories of unused consumable stores will appear as the current assets. They should be shown under their own heading of say inventory of uses. They should never be included in closing trading account. Practical application of the maximum concept. This is a practical application of maximum concept. It is necessary to apply the items in the this means that the profit or loss will be known as more accurately than it allows for the use of a symbol diagram is often employed in calculating the to a particular time. This is illustrated in the accrued expenses. An accrual is an amount due in an accounting period which is necessary at the end of the accounting period, where an expense is accrued in the situation of a service has been received during the accounting period, but this benefit or necessities will not be paid for by the end of the period. To apply the matching principle, the amount transferred to the into the income statement should represent the expense for the income accounting period covered by that amount. This means that the amount due but unpaid at the end of financial year will be added to the amount transferred to the income statement. The expense amount will now show a balance equal to the amount as paid. To complete the double entry, this balance is not known as the balance represents an amount of due to be included as a third balance. Prepaid expenses. Prepayment is an amount that is paid in advance where an expense is prepaid. It means that the payment has been made during the financial year. As with the accrued expenses, the maximum principle will be applied so that the amount transferred to the any amount paid during the financial year related to the future accounting period must be directed to the amounts of paid so that only the expense will be the accounting period. The expense account will now show a balance equal to the amount paid in advance. To complete the double entry, this balance is brought down on the debit side of the ledger. The balance representation of the which the business has paid for purchase, not in the opening balances on expenses. Greater and definition, the care of business and the business account. There might, however, be a closing balance that will be considered the opening balance. This must be considered the correct calculation. Combined expense account. Sometimes the business may use on ledger account for different for that account. The only difference is that the accrued income, where an item of income is accrued income, then another person is the totals of the same way as it is expressed to the so that the amount transferred to the income statement represents the income for the account. This means that any amount due but not received at the end of the financial year and the total income the income account will now show a balance equal to the amount not yet received. To complete the double entry, this balance is brought down on the debit side of the ledger account as the balance represents an amount owing to the business due to received income included as a debtor. Prepaid income. When an item of income is prepaid, it means that a person has paid for the use of business, but this has not been provided to the business. Once again, the matching principle applies so that the amount transferred to the income statement represents the income or any amount received in the financial year. So that only the amount related to accounting period is transferred to the income statement. The income account will now show a balance equal to the amount received in the month. To complete the double entry, the balance is brought down on the side of the ledger account. This balance is executed at the as the business is a liability to provide some entries or publish the business account. Opening balances on income accounts. The second and subsequent years of credit business may have opening balances on income accounts. These must be considered when focus on closing balances. Assets have opening debit balance but closing credit balance income debit balance in income. Liabilities have opening credit balance but closing income. Closing become credit balance in income. Accounts of limited companies. How to start and finish syllabus. Study each topic clearly, work out examples, repeat until you understand. Practice exam questions. Practice mock exams. Unit exam questions. An introduction to the account of this lesson we learn what limited legal requirements, format of financial statements, share reserves, bonus issue, all together we discuss the practice questions. Identify limited company. Limited company is a legal entity which has a separate entity shareholders whose liability for the company is themselves. Sometimes a new business is formed as limited company. Sometimes the limited company is formed in suitable share capital. The nature of the limited company, one person acting The capital of the company the shareholders of the company for the debts of the company up to the since a company can have shares, members a large the shares of the company have this value per values profits are distributed which are often stated in terms of public limited was there are two types of shares and it's not limited in form of the it is also beneficial that a limited company has action that they can part in this one for the shareholders we can actually for the written from the viewpoint of the company possible for rules cannot be or a partnership. Partnership. Somewhere there are share limited companies formed by a company will not be able to the shares in this case shareholders the amount of this may be like the Asian capital only call of the amount in actually little bit of capital goes to the part of the capital part of the company that types of share capital of limited company ones are preferential the need place is the difference of partnership is stable before we audit the before not types of several types of differentials are important differentials are differentials are organizations these are also organizations the trading business of those organizations council lands the total cost of the show the probability, showing the probability state. That is the change in the form of variance. In obligation, sometimes the derivatives will be during the operations. Also, the connection here, they are included in this video of the office over the any profit that is not a profit. In addition to balance, the generators are also business. State performance. And any other and then related accounts of manufacturing business. How to start and finish it. Have a bird's eye view of the entire sequence. Study the start. Work out examples. Repeat until you understand. Practice examinations. Practice confidence. In this lesson, we learn everything about how to prepare manufacturing formats, how to calculate altogether we discuss some practice questions. Manufacturing business. The previous chapters related to business Syllabus. There are of course manufacturing businesses. David Hopkins. Manufacturing business will bring costs. At the end of the financial organization, state possibly an appropriation. The purpose of preparing this account is to calculate how much it has cost the business to manufacture. Manufacturing is part of annual financial statements. Elements of cost of manufacturing the first thing manufacturing needs is raw. This raw takes baker will need the next essential part of manufacturing cost. Depending on the input, cost is the term direct labor includes only those people who are actually involved in the production of chemicals. It does not include the businesses. The elements of cost, direct expenses. There are many expenses which a manufacturer can directly that for every item manufacturer active workers. Sometimes recruiters not because of being expenses. Factory machine as factory preparation of manufacturing, cost of manufacturing, the cost of in which you literally calculate cost often in this carries only minus cost of the entire the total of these elements cost the total cost of machines what which is part of it has some value of as possible some to them the partly maintenance the adjustment is calculation of gross profit is very simple to prepare because the business actually sometimes which is not that much action does not only administration is necessary. Allocation of expenses. Expenses to the whole of the expenses such as insurance, for example, the factory and this to put the this related financial information of the state. There is only one engineering to show itself here and this distance not the non-profit organizations, clubs and societies have to start and finish study. However, study is not only important. Repeat until you understand. Practice. Practice. In this lesson, we will know about new forms of finance. all many disciplines is balance and the balance is so the bank a balance made of the bank debit balance is a discipline on the society receipts and no distinction during the conference should be added to the question. Surplus of the income and expenditure on this control. Surplus are reflection of income and expenditure. With the gains and with the gains and expenditure upon this paper. This non-monetary Published company accounts, international accounting standards. How to start and finish. Have a study of the entire syllabus. Study each topic. You work out examples with these questions until you understand. Practice questions. Practice mock exams. Simulate exam conditions and published company accounts. In this lesson, we learn everything about international accounting standards, reporting standards, International Accounting Standard 1, 2, 7, 10. All together, we discuss and practice questions based on these concepts. Identify and practice. We also learn the financial statements and reports that may be published on central shareholder. Reporting standards relating to the company. Reporting standards relating to the financial position. The role of the shareholders of the limited company. The role of directors of the limited company. The contents of directors' reports. The role of auditors of the limited company. The importance and convenience of auditors. Generally accepted accounting principles. Accounting standards ensure compliance with the true and fair view concept. All companies are required to comply with accounting standards or regulations for accounting standards. Company orders are required. Company auditors are required to ensure that the company accounts are prepared in accordance with the standards and report any significant departure from the standards. The standards help to increase uniformity in the presentation of company accounts and to reduce the subjectivity in the disclosure of information. International accounting standards have been developed in the form of international accounting standards and international financial reporting since 2005 with the aim of harmonizing all standards in financial reporting. Private UK companies are permitted to choose between international and national standards. Companies listed on a stock exchange are required to adopt international standards and semi-large or multinational private companies adopt them model. The Cambridge International Examination Syllabus identifies a number of international economies with the content of this given in the area of cognitive identification. Some of some have already been covered in this chapter. The remaining ones and some aspects of the others not in this chapter. Presentation of financial standards in chapter 19, inventories in chapter 16, statement of cash flows chapter 23, accounting policies chapter 22, events after the statement of financial position chapter 22, property, plant and equipment chapter 22, earnings per share chapter 22, impairment of assets chapter 22, provision of contingent liabilities and assets chapter 20, intangible assets chapter 20. Chapter 22 is this chapter, so which is mentioned as company financial statements or international accounting standards. This is chapter 20. Accounting concepts. Although not an accounting standard, the conceptual framework has been developed by a body which is the International Accounting Standard. This sets out the principles which underlie the preparation and presentation of financial statements. The framework identifies the main features of financial statements are set out below. The framework surrounding IAS identifies the typical user of accounting statements. The table below identifies the user stakeholders and use likely reasons by no means exhaustive for the financial statements. Main users, reasons for investors to assess part performance on the basis of future investment. Employees to assess performance on the basis of future events and organizations. To assess performance on the basis of continuity of employment and responsibility. Lenders to assess performance in relation to security of the loan. Suppliers to assess performance in relation to the needs. Customers to assess the performance in relation to the loan. Government to assess performance in relation to compliance. Public to assess performance in relation to education. Chapter 9 set out a number of accounting concepts which are important in preparing the financial statements. However, these are perhaps more important in the context of preparing financial statements that they are prepared on matching basis and the business requirements. IAS 2 inventories. This statement deals with the valuation of inventory which is entered in the statement of financial. The term inventory refers to the unsold goods in the business. Companies have inventories in the area of raw materials for use in subsequent manufacturing process, partly manufactured goods, completed goods ready for sale to customer, finished goods in the business has bought for resale to customer. The principle of inventory valuation is set out in IAS 2 is inventory should be valued in the cost, lower of cost and net realizable value. This was also covered in chapter 16 in the preparation of accounts from incomplete cost of discussed. Notice the exact wording, it is the lower of cost and net realizable value, not the lower of cost or net realizable value. The situation when the company holds a number of different lines of inventory. It is rare for a limited company to hold this one particular line. For example, clothing store may hold both men's and women's clothes. For men, it may hold shirts and trousers. This should be regarded as unusual for difference. In this case, inventory should also be considered on a line by line basis. Inventory valuation methods where items are bought and used on regular basis. Certain businesses, particularly manufacturing units, hold a number of different methods which are used in making the product. The cost of these items varies both over time and depending on which the firm buys the items. This causes a number of problems with the estimation of such inventory. IS allows two different methods for use for valuing this type of inventory. FIFO, first in first out method. This assumes that the first items to be bought will be first to be used. Although this cannot be physically distinct from goods, this may remaining inventory valuation will always be value of most recently consumed. Average cost. Under this method, any average value usually debited average using the number of items bought is calculated each time and executed by the inventory. This is all covered in detail in section 28.5. Its reference should also be made. Valuation of inventory at the lower of cost and net realizable value. The principle of inventory valuation is set out in IAS. So far, we have seen that inventory can be valued using any one of the two different methods, FIFO or average. Since these are the only two methods of inventory valuation which IAS 2 allows. We have also seen that whichever method is chosen can achieve a lot of it. We also saw the standard says the inventory should be valued at the lower of cost and net realizable. is the price that you use expected to be received in sale of goods less the cost of putting them into saleable condition. The cost includes the cost of completing the goods in the manufacture plus marketing, selling, and distribution cost. The term net realizable value can be compared to the selling price of the product. If the expected selling price is lower than the cost price, then inventory should be valued at its selling price. Inventory is never valued at selling price when the selling price is greater than the cost. By using the lowest price possible to value, this means the inventory valuation follows the prudence cost. Similarly, inventories which are similar in nature and use to the company will use the same evaluation method. Only where inventories are different in nature or use can be a different valuation method used. Once a suitable method of valuation has been adopted by a company, then it should continue to use that method unless there are good reasons why a change should be made. This is in line with the consistency concept. Valuing work in progress and finished goods. IAS2 requires that the valuation of work in progress and finished goods includes not only the raw or direct material content but also includes an element for direct labor, direct expenses, and production overhead. The cost of these two items therefore consists of direct material, direct labor, direct expenses, production overheads. These are costs to build the product to its present location and commissioning, or other overheads which may be applicable to bring the product to its present location and commissioning. The cost of these two items is abnormal waste to the production process, storage cost, selling cost, administration cost not related to product. Replacement cost. Replacement cost is the price that will be have to pay to replace goods used or sold. The replacement cost may be the largest price of the latest price of the goods or an estimate of what the price will be at some future date. Replacement cost is not accepted as a basis for valuing inventory under IAS. However, replacement cost may be used to estimate the cost of a particular job and quoting for another for an order. Using a price based on historic cost may lead to an underestimate of the price for a job and a lower cost. Replacement cost is usually more realistic for this. Replacement cost should be also be used when preparing budget. See chapter 24. The chapter 1 budget. The standard does not allow the inventory to be valued using the latest in last in first out LIFO method. Last in first out method LIFO method. Similar inventories which are similar in nature are used to comply are used to the company will use the same valuation method. Only where inventories are different in nature or use can use a different valuation method or be used. Once a suitable method of valuation has been adopted by a company, then it should continue to use that method unless there are good reasons why a change should be made. This is in line with the consistency concept. IAS 8 Accounting policies, changes in accounting estimates and errors. This statement deals with the treatment of changes in accounting estimates, changes in accounting policies and errors in the financial statements. Accounting policies. These are the principles, basis, conventions, skills, and practices applied to and prepared financial statements. These policies are selected by the directors of the business. Selecting them, they must make sure that there are accounting policies given in accounting. The policy they select must comply with the standard. When there is no accounting policy provided to give guidance, then the directors must use the information that is relevant and relevant. The directors must refer to any standard or interpretations to other standard setting bodies to assist them. However, they must ensure that their subsequent interpretation of the method of treatment for the transaction does not relate to conflict with the international standards or interpretation. Examples of accounting policies can include the method of valuing inventories or the method is used to depreciate non-current assets. Accounting policy. These are the principles, basis, conventions, rules, and practices applied by business when preparing and presenting financial statements. These policies are selected by the directors of the business. Selecting them, they must make sure that where an accounting policy is given in the accounting system, then the policy they select must comply with the standard. Where there is no accounting policy provided to give guidance, the directors must use their judgment to give guidance. The directors must refer to any other standard or interpretations of other standards before discussing. However, they must ensure that the subsequent interpretation of automatic method of treatment for the transaction does not result in conflict with international standards or interpretation. Examples of accounting policies can include method of valuing inventory or depreciation of accounting principles. These are covered in the statement. Also, no formal definition is included. They are regarded as the broad concepts that apply to almost all financial systems. These would include substances, governance, and materiality, prudence, and consistency mentioned earlier. See chapter 9. Accounting basis. These are the methods developed for applying the accounting principles by identifying and applying a conceptual method. The general rule is that once an entity adopts an accounting policy, then it must be applied consistently for similar transactions. Changes in accounting policies can only occur when the changes in required by standard or information or if the change uses in financial statements providing more reliable and aligned information. Once any changes are adopted, then they must be applied retrospectively to financial statements. This means that the previous figure for equity and other figures in income statement and statement of financial position must be applied, subject to the practicalities of calculating the environment. Examples here are the method and rate used by companies to depreciate statement. Another would be the way in which value it values inventory. For example, if the value includes material and labor costs are proportional to alternatively whether two for dealing with errors. If an error in the financial statement is discovered, the business must correct materials from the next comparative amounts from the previous years may be used subject to the practicalities of calculating the revenue. In this instance, errors are omissions from or misstatements in the business financial statements covering some one or more periods prior periods. They could be something as simple as a mathematical mistake made when preparing the account, and also include the failure by directors to use reliable information which was available in the top tip. Say the directors are considering changing the any depreciation is calculated or inventory value in order to improve the profit. It is important to remember that we should not make any changes. So as to do so would mean that this IAS will not be followed. IAS 10 events after the statement of financial position date. These are events either favorable or unfavorable which occur between the statement of financial position date and the date on the financial statement. Such items may occur as a result of something become available after the end of the year and therefore need to be disclosed in the account. If they occur, then amounts included in the financial statement. This they may indicate that the concern is not appropriate. The key is the point in time at which changes the financial statements can be made. Once the financial statements have been approved by or issued by the board of directors, they cannot be altered. For example, the accounts are prepared up to 31st December. They are approved for issue and they are approved for issue by the board of directors on the given form. Between these two dates, changes in results from months after 31st December can be disclosed in the accounts. After 30th April, nothing can be changed until the next annual accounts are prepared. The statement distinguishes between two types of events, adjusting events and non-adjusting adjusting events. If at the time of if at the date of financial statement, evidence of condition existed that would materially affect the financial statement, then the financial statement should be changed to reflect these conditions. Examples of adjusting events would include the settlement after the date of statement of financial position of the court case which confirms that an obligation on existed at the date of statement of financial position. The purchase price or profit from the sale of non-current assets bought or sold before the year end was known, but not known about the date of the statement of financial position. Inventories where the material value falls below the cost price. Assets where valuation shows the impairment is required. Trade receivables where a customer has become insolvent. The discovery of fraud or error issue the non-adjusting events. No adjustment is made to the financial statements for such events. If material they are disclosed by way of note to the financial statements. Example of non-adjusting includes major purchase of process of production, investment, hardware, cost, action, announcement or commencement of major construction, reconstruction of the business. The company enter into significant commitments or change continuing warranties, commencing litigation based on events arising after the statement of financial position. Major share transactions such as the issue of new shares and debentures of capital reductions or reconstruction. There are three situations in addition to the above which require consideration. Dividend declared or preferred after without statement of financial position are no longer recognized as a current in the financial statements. They are non-adjusting events and are now to be shown by way of note to the accounts. If after the date of statement of financial position, the directors determine that the business index ceases trading and there is no alternative to this act for submission, then the financial statement cannot be prepared on a going concern basis. The business must disclose the date when the financial statements were authorized for issue or and who gave the authorization. If anyone had the power to amend the financial statement after their authorization, then this fact must be disclosed. asked about events occurring after the date of statement of financial position and for read after financial statement to take account of charges provided. Learn the items in the list and apply them accordingly. IAS 16 Property, Plant and Equipment. This statement deals with the accounting treatment of the non-current assets of property, plant and equipment. The issues covered by the statement are recognition of the asset when the item is recorded in the account, the determination of their carrying amount, what value is based on their depreciation charges, their impairment process, what happens when the value of the system is low, then that shown in the accounts. Property, plant, and equipment are tangible assets held for use in the production, supply of goods and services, for rental, for others, and for administrative purposes. They are expected to be used by a business for a period of more than 1 year. For example, a company may buy some plant and machinery at a cost of $50,000 and expect the plant to be used for 10 years and then the hold to be sold for 1 year. The depreciation amount will be 14,000. Assuming the company uses straight line method of depreciation, then each year $1,400 will be recorded as interest income stream. This example allows reference to remain to definition and they are depreciation. This is the allocation of the cost of an asset over its useful life. This is the $1,400 return on depreciable amount. This is the cost of valuation of the asset plus any residual amount. This is the figure of $14,000. Useful life. This is usually the length of time for which an asset is expected to be. This is the period of time for the company use for the time. There is an alternative. If the asset is depreciated on the use of on the basis of number, which is produces when the estimated output of the item over its useful life can be residual value. The net amount the business expects to obtain for an asset at the end of its useful life after deducting the expected cost in this period, this will be the figure of $1,000 if the company hopes to sell the assets for at the end of its useful life. The standard also uses some other terms which need to be aware of. Fair value. This is the amount for which an asset could be exchanged between knowledgeable business parties in an arm's length transaction. If, for example, after 5 years the company decided to sell the plant and offer its equal to buyer at $5, this will be regarded as a fair value to the item carrying amount. This is the amount at which an asset is recognized in the statement of financial position after deducting any adjustment. This is, in effect, the net book value of the asset shown in the statement of financial position. At what point does an entity recognize the asset, or put more simply, at what point is the asset to be recovered in the financial statement? This must be done when it is probable that the business will be able to use it to generate revenue and the cost can be assigned to it. If an item of property, plant, and equipment qualifies for recognition as an asset by meeting these criteria, then it bought into account and initially valued the cost. Additional costs associated with that. The statement recognizes that in addition to the initial purchase price of the asset, other amount in also this statement provides the following guidelines for the treatment of such expenditure. Day-to-day cost of service repairing the asset should be charged with expenditure in the industry. Where parts require replacement at regular intervals, the assets and then these costs can be added to the cost of the asset in the statement of financial position and depreciated accordingly. Where the asset requires regular inspections in order for the asset to continue operating, then the cost of such inspections can also be added to the cost of the asset in the statement of financial position and depreciated accordingly. When the asset is purchased, apart from its original cost, the business may also pay other costs as part of the purchase price. The standard provides information as to what can be included as part of the cost of the statement of financial position. Any import duties, taxes directly applicable to the asset which present location and condition. The cost of site preparation, initial delivery and handling cost, installation and assembly cost, cost of testing the asset, professional fees, any say architects or legal fees. Valuation of the asset. Once the asset is acquired, the business must develop one or two models of its valuation. Costless secondary depreciation, revaluation. This as the asset is included carried at revalue amount. As revaluations are to be made regularly by suitably qualified people to ensure that the carrying amount does not differ significantly from a fair view of the asset in the date of the statement of financial position. Revaluation should be undertaken by the business with a sufficient regularity to ensure that the carrying amount is up to date. For example, every 3 to 5 years. Unless assets are bought and sold frequently, if an asset is revalued, then every asset in the class must be revalued. Thus, if one parcel of land and building is revalued, then all lands buildings must be revalued. Any surplus on revaluation is reported in the statement of comprehensive income and transferred to the equity section of the statement of financial position. Differ significantly from the fair value asset EBITDA statement of financial position. Revaluation should be taken by the business with sufficient regularity to ensure the carrying amount is approved. So up to date every 3 to 5 years. Unless assets are bought and sold frequently, if an asset is revalued, then every asset in the class must be revalued. Thus, if one person of parcel of land and building is revalued, then all land will be revalued. Any surplus on revaluation is reported in the statement of comprehensive income and transferred to the equity section of the income statement of financial position and the revaluation report. This may not be used to pay dividends to the shareholders. Any loss on revaluation is recognized as income statement unless the revaluation reserve has surplus in the same asset. Depreciation. The expected life and residual value of the asset are to be reviewed on at least annually. If there is a difference between the previous estimate, the discussed the same estimate under section IAS 8. Accounting policies changes in accounting estimates. Depreciation must also continue to be charged even in the fair value of assets exceeds the carrying. However, depreciation need not be charged when the residual value is greater than the carrying amount. Depreciation is to include the payment. The business must choose a method of depreciation which reflects the pattern of its usage. Ideally, once the method has been decided, it should not be changed. It is possible, though, to review the method. And if a change in the pattern of usage of such a method, then the method of change. Such a change would come under IAS. Disclosure in the financial statements. For each class of property, plant and equipment, the financial statements must show the basis for determining the carrying amount, the depreciation method used, the useful life of depreciation, the gross carrying amount of the minimum and the end of the account, the accumulated depreciation and impairment losses at the beginning and end of the account, addition during the disposal, depreciation and impairment for the period. These are likely to be shown by way of non-current asset schedule and included as a note to the account. An example of this is shown below. So probably we have to learn the format like this. For example, see non-current assets. Let us say the assets are premises, plant and machinery, motor. So everything should be listed. So there should be it should be divided into two parts. One is cost part and one is depreciation part. In cost part, you have to show cost at the start of the year, revaluation, addition during the year, disposals during the year, cost during the year. So total amount you have to say. This is the way you have to present it. So in the IA said, this is the way. This is the very important format which you have to learn by heart, practice whatever. So depreciation. Depreciation part you have to show what is the depreciation and the balance at the start of the year, revaluation undertaken, charges, depreciation charge during the year, disposals, everything must be disclosed. And net book value at the end of the year and net book value at the start of the year also should be disclosed. So this is the format. This is just an example. So this is the way you have to learn it, you have to practice it, and you have to learn. It's very important. IAS 18 revenue. This statement is no longer in the syllabus. However, for the purpose of clarifying what is meant by the term revenue, statement is included. Revenue is defined in the statements as gross inflows and benefits arising from the ordinary activities of the entity. This means the sales either of goods and services. It also includes income from interest, say bank interest, dividends received, and royalties from non-revenue activities, which is the processing disposals of non-current assets. It does not include money collected by business on behalf of another party, say where the business activity. However, any commission earned for collecting money as a movement is included. When a transaction takes place, the amount of revenue usually decided by the government between the buyer and the seller. The amount of revenue measure will take into account any trade discounts not influenced as part of the revenue. The sale of goods is to be accounted for when all of the following criteria. The seller of the goods have transferred to the buyer the significant amount of commission. This is usually when the legal title to the goods transfer or commission of the goods participants in the trade. This covers goods sold on a sale or return basis where the title has not been passed to the buyer. The seller retains no continual managerial involvement in and no effective control over the goods. The amount of revenue can be reliably measured. It is probable that the economic benefits will now flow to the seller. The costs incurred or to be incurred in respect of the transaction can be reliably measured. The sale of goods is to be accounted for when all of the following criteria have been met. So when the income is interest, the amount to be recognized is calculated using time basis matching concept. If the income is dividend, then these are bought into our income statement. When the shareholders' right to receive payment is established, dividend is received or bought into the account when the shareholders' right to receive payment is established. IS 23 borrowing cost. This statement is no longer in the syllabus. However, to illustrate what is meant by borrowing cost, how they fit with the finance cost shown in the income statement is included. This covers such items in the accounts as interest on bank overdraft and how they remain in the income statement of the previous year. The borrowing cost is interest and other costs incurred by the business in connection with borrowing. This covers such things as bank loans or overdraft interest. The statement provides that borrowing costs are to be recognized. An alternative to this is when the borrowing relates to acquisition, construction, or production of property. In this instance, the borrowing cost can be capitalized as part of the cost of the asset. For example, if an asset is being constructed and is planning the use of borrowed funds, then any interest payable on borrowings can also be added. Suppose a company borrows $10,000 to construct a building, while the building is being constructed, any interest payable on $10,000 can be capitalized as part of the cost of the building. Once the building is completed, then any further interest payable on $10,000 under finance cost. If any of the funds borrowed are temporarily invested in a short term and then generate interest, then this interest must be offset against the borrowing cost. Earnings per share. This statement is no longer in the syllabus. However, the calculation of earnings per share appears in the list of ratios in the exam. Hence, it's included. There is a ratio. This is a ratio widely used by investors and analysts to measure the performance of business and is considered again in chapter 28. Chapter 28 deals with the ratio analysis. So, analysis of financial statements. The earnings of company are the profits or losses for the year that are attributable to the equity shareholders of the business. In other words, the profit for the year from the income statement less any dividend payable on non-redeemable preference shares. IS 33 sets out a basic method of calculating earnings per share, which is profit for the year minus non-redeemable preference share dividend divided by number of shares, ordinary shares, or the divided by number of ordinary issued ordinary shares. As the non-redeemable preference shares are regarded as part of equity, any dividend payable to them will be adjusted in the statement of changes in equity. Published accounts earnings per share always shown in the income statement for both the current year and the previous year. They are always expressed in cents per share. Dividend on non-redeemable preference shares should be deducted from the profit attributable to equity shareholders before calculating the earnings per ordinary share. IS 36 impairment of assets. The purpose of this standard is to ensure that the assets are shown in the statement of financial position at no more than their value or recoverable. The term recoverable amount means the value that the business can recover by one means or another from an asset. The formal definition is given below. If the recoverable amount is less than the amount of carrying, if the recoverable amount is less than the amount of assets shown in the account, its carrying amount, in effect its net book value, then the carrying amount must be reduced. This is an impairment as loss and must be recognized as an expense in the interest. The standard applies to most non-current assets such as land and building, plant and machinery, motor vehicles, and so on. It also applies to intangible assets such as goodwill and investments. It does not apply to inventories, which are subject of their own standard IS. Some of the terms in their standard have already been covered in section 22.8 and IS 16. However, there are some other terms used in the accounting standard which require explanation. Amortization. This usually refers to writing down of the intangible assets such as impairment loss, the amount by which carrying amount of an asset exceeds its recoverable fair value less cost to sell. The amount obtainable from the sale of an asset in an arm's length transaction is knowledgeable willing parties less the cost of the disposition. Recoverable amount. In respect of the asset, the year of its fair value less cost to sell and its value in use. Value in use. The present value of the future cash flows obtainable as a result of an asset's continued use, including cash from its ultimate disposal. Useful life. This can be either the period of time which the asset is expected to use the business or the number of units are operated. The impairment review. Businesses are expected to undertake an impairment review of their assets and there is indication that this may be impaired because there is a reduced demand for the product may be made by a particular machinery or type. In other words, assess whether or not the assets net book value in the financial statement is a fair representation of its true value. The impairment review involves comparing the assets carrying amount with the recoverable amount. It is carried out in three stages. Stage 1, calculate the assets carrying amount, its net book value. Compare this with the assets recoverable amount. The recoverable amount will be higher of the assets fair value less the cost to sell. The assets value, this is the present value of future cash flows to the business generated as a result of using value. Stage 3, compare all values calculated if either A or B is higher than the assets carrying amount, then there is no need to reduce the carrying value of the asset. However, if both are lower than the carrying value of the asset, then the carrying value must be reduced. Learn the way in which carrying value is compared with the greater of distribution and cash flow from the asset, often called the asset value, and their fair value is less cost to sell. You may also be asked to write about what you have done. IAS 37, provisions, contingent assets, and contingent liabilities. These items represent uncertainties at the time of the financial statements are prepared. They need to be fully accounted for as for on a consistent basis so that readers and users of the accounts can have a better understanding of their effect on the account. A provision can be defined as a liability of uncertain amount or timing. An example, how here would be provision for the cost of repairing books that it has sold with long-term warranties and where it knows from experience that at least some will break down. So provisions are only shown in the accounts and there are valid loans for them. They should never be used as a way of input risk. It's likely that the firm will have to make a payment for something. The amount it will have to pay can be reasonably estimated. Then it can reasonably bring a provision into the accounts. Once, on the other hand, a liability is a present obligation on a business. A present obligation a business has as a result of past years, where its settlement amount is known and it is expected to result in payment of payment being made. For example, a business has a liability to pay its suppliers for goods and services they are provided. There is another class of liability known as maintenance liability. This is a possible liability to pay the business which arises from past years. However, it may result in the business having to pay for it only when a decision is made which is outside the company's control. For example, someone may be suing the company for faulty goods. There is a possibility the company will have to pay damages to the other party. However, the decision will be made by the court. This decision and the amount of payment will also the company's control. A contingent liability is not recognized in the account but is disclosed by of note to them. This will describe the nature of the contingent liability. An estimate of how much it is likely to cost as an indication of the uncertainty related to the amount of outflow of funds. There is also a contingent asset which may affect a company. This is a possible asset arising from past events which will materialize when something happens which is not entirely within the company's control. A contingent asset should never be recognized in the account. So as to do so may be in so may be to bring in revenue that may never be realized. However, when the profit is almost certain to arise, it is no longer a contingent asset and it should then be recognized in the account. In other words, the accountant will include an amount which will be received. The IAS under three words uses three words which talk about provisions, contingent assets, and contingent liabilities. They are probable, more than 50% chance the inventory letter, possible, less than 50% chance the inventory letter, remote, zero or no chance the inventory. The following provides guidance of how items falling within these headings should be treated. Provisions more than 50% likely not improbable. In this case, the amount should be entered in the financial statement. There must also be a note to the account giving details of these figures. Contingent liabilities less than 50% likely are involved. In this case, no amount is included in the financial statement, but the note to the account is given from the contingent liabilities. Contingent liabilities which are remote, in other words, almost like unlikely plan. In this case, no figures are shown in the accounts. In other words, any note to the accounts. Contingent assets with more than 50% chance of occurring probability. In this case, no amount is included in the account. However, a note to the account is provided in the contingent asset. Contingent asset is less than 50% chance of occurring both positive and negative. In both cases, no amount is included in the account. There is a no to the accounts. So basically, a note is given. It is not recognized now. Just a note is given. IS 38, intangible assets. An intangible asset is an identifiable non-monetary asset without a physical substance. The best example of an intangible asset is our patents and trademarks are also regarded as intangible assets. In other words, it is something which has value, but unlikely, say, plant and machinery cannot be tracked. In terms of the definition given above, in order for it to be an intangible, the asset must be capable of being sold separately from other parts. As for instance, a customer could be an intangible asset. A customer list could be an intangible asset as it can be sold separately by the entity. In an instance such as this, the entity has a control of the asset and its asset will also bring future economic benefits to the organization. Intangible assets can come from two sources. Firstly, they may be purchased. For instance, the business may buy the patents or personal products from. Alternatively, a business buys another at a figure in excess of the net book value of the assets. So the more then purchases. Alternatively, they are generated internally within the business. For instance, the goodwill which alternatively they are generated internally within the business. For example, the goodwill which is valued when a partner leaves a business partnership or a new partner. In both cases, the goodwill has been internally generated by the business partner. The general rule is that only purchased intangible assets are recognized in the account. The intangible asset is shown at cost plus any payment for amortization and important process. An intangible asset of a type that is freely traded at a public market price must also be shown at a revalued amount, being its fair value CIS 36 internet asset less any amortization of the process. In this case, any loss in value is shown as an expense in the income statement. Any surplus is credited to the revaluation on the statement of financial position. In every case, the business must identify the usefulness of the intangible. In the case of those intangible assets having a finite life, they should be amortized with the straight line method. In this case, the residual value should be assumed as zero, and the amount of the amortization should be charged as an expense in the income. The amortization period should be reviewed at least annually, and any changes to the amount should be charged made in line with such a review. Where the asset is deemed to have an indefinite life, then it will not be amortized. Instead, accounting standard requires that it will undergo an annual impairment review. Part of the review must also consider whether or not an indefinite life is still valid in respect of the asset. Any loss in value arising from such a review is charged on expense in the income statement. As an asset with an indefinite life will be written down. If at all by one or a series of irregular impairment charges. Whereas an asset with a definite life is not in predictable installment. The standard also provides guidance to business which can undertake research and development. In doing so, it provides definition of it. Research is theoretical work undertaken to gain new knowledge. This may or may not have some commercial benefit in the future. In this case, expenditure on research is to be written off as an expense in the income statement. Any non-current assets which are purchased with the result of research can be capitalized and written off over their expected useful lives. Replace development. Development is moving on a stage. It is perhaps using research to develop a product which is the business can use to generate sales at some point. A good example here is the automotive industry where the research into green technology may result in the development of an emission-free car. In this case, development expenditure can be written off as an expense in the income statement. In the period in which it is occurred. Alternatively, the expenditure can be recognized as an intangible asset in the statement of financial position of the business. Costing for materials, labor, and overheads. How to start and finish study. My personal opinion that syllabus study is starting very good. Therefore, take number of students. Repeat your practice. Never ever resort to shortcuts. Senior exam preparation. In this lesson, we will learn everything about the nature and purpose of cost reporting, analyze costs into direct and indirect costs, look up calculated cost basis, allocation and unallocated, most allocated, overall method, base concept of over and under allocated. Altogether, we discuss in practice based on these concepts, identify the purpose and nature of cost reporting, how the number of systems of God, obtainable from financial accounting. As given the way data is collected and how the sensible is produced. This section is completely different to the way it is collected in the database management. Some larger businesses will have specific department staff dedicated to cost and management. They provide a valuable identity documents or and for analytical accounting to able to store and distribute. The financial statements are prepared after the financial with cost and management accounting documents affecting the performance and profit. So, now there is also some overlap with management accounting for the cost of parts and labor units of products, energy, value and direct and indirect costs. So that is direct costs include direct material of some and direct material indirect labor, the wages of original and direct indirect costs on the other hand are indirect purchased by the company in the US. Claims convenience are usually used for indirect wages to reduce cost and activity necessary for installation, transfer, and other overhead costs like it is important that you are able to calculate the costs. The behavioral costs. Direct costs are linked to various proposals to the number of costs. Production could be used for royalties and other personal as we pay for every royalties for every number of times. At one time, we have A, it has been necessary to learn additional mainly and the and B, a further machine has been bought and it has been used during additional activity to so the depreciation charge is very high. So the fixed cost line is upon a whole form. A whole making the whole line look like steps. Step fixed cost. So step fixed cost means the fixed cost is equal to the increasing level of so the level of purchasing across this level of purchasing is across fixed cost. Recording materials labor and overheads. Cost of price is completely classified as direct and indirect. The total remaining are reviewed as part of the fixed cost. They are regarded as direct based on mountains, boards, and surfaces with predominantly direct. Cost includes direct material cost, hence direct cost. Cost accounting the main unit of the unit of cost. We will refer to the uncertainty cost. If the business issue is close to its purpose to ensure no discovery is related to the it is called the cost of this is evaluated. It can be usually the number of employees and this is cost of the the total cost of all the indirect expenses are added together and they are then charged to each cost unit on a weighted basis. This is covered in the next chapter. Cost accounting requires both certain budget and as the classified as direct cost. If expenditure has been incurred for particular cost, it is cost and the basis is reported in the purchase. It shows the type of the purchase items have additional cost included. The expenditure can be analyzed according to the cost of the items. Wages are under different departments and then classified into direct, indirect wages, on direct income. If the systems of analysis of high-tech data, all expenses can be calculated using the profit account. The real reality and the cost centers as described in section 1. Direct and indirect wages. Manufacturing is more than number of basic items of the market over time. This form is a number of when considering the effective one or two yeah, first in first out. This has the first item is what first will out of this present. Remaining into identity orders so we'll be working on practical problems based on this. So average variable cost, average cost. Under this definition, average variable value equal to related average. In a very few cases, it is possible to value both the price and the paid for. For example, the owner of an art gallery may be able to say that from art issue what and how much to pay for it. Because they will be probably able to for how much you pay for. The manufacturer of computers, however, not really how much you pay for the parts purchases of hard drive and there are different types of how much has been paid for particular hard drive. The problem is solved by the not still so the problem of sometimes something that will happen not solved. Value material as we have seen under the order is here received in the supply. So you think about unless you not understand this unless problems are actual work. Value is now unlike before, no priority is the weighted average of this process is extremely complex stages by the value of the application. SQL and periodic table design create a record of fields, values, and multiple the examples include copies and values. So periodic table features the balance between including different items in periodic table, including the proof becomes control of calculating the error rate using table analysis is an example of periodic table. are approaching the respective flow leaders of the department. Power is neither separately because the active document is never been provided in insurance of planned engineering and development on part of replacement values of the system. Depreciation of contract features and the cost of inventory and assets. When calculating the overhead factor, output of the input the answer to the when the supply down the target portion of service cost total cost used by the or the basis will be adopted as sales percentage or divided stores cost of stores divided number of values production cost can be equivalent percentage the basis of production cost standard measurement of this is proportional to this number of values. However, cost of actual material cost is the cost of material cost. There are a number of ways of measuring cost in this subject. One is the non-linear one. The simplest method is it is now necessary to approach the overhead of concerning department production cost. The single department cost if this is the case, there is no then answer is possible. With the mass how to allocate the overhead itself. Once overhead factor approach to was physically calculated the overhead plus cost is decided however passenger electricity it is quite common to see in the the only second more common covered in D. Prepare the calculus other bases of calculating the following basis for calculating the direct method of order of contributing to the product direct level the labor cost product profit product what the awareness to the the same time when purchase method combined with the same cost this method is restricted to the other are also actually that of the other product more of the actual expenditure and the production actual production this is to the fuel and the cost practice calculation learn how to calculate method of the calculation the calculation important calculation not that Unit job and batch costing. How to start and finish studying. Have a bird's eye view of the entire syllabus. Study each topic thoroughly. Never ever resort to start first in study. Work out examples, illustrations, and exercises. Repeat until you understand. Practice exam questions. Practice mock exams. Simulate exam conditions and practice. Unit job and batch costing. In this chapter, we will learn the difference between continuous and specific order operations, what unit costing is, what job costing is, what batch costing is, how to prepare a quotation for a job. Continuous and specific order operations. Costing systems may apply to every type of business, including public or privately owned organizations, manufacturers of goods such as metal cars, breakfast cereals, providers of services, example hospitals, hotels, restaurants, lawyers, and accountants. Each type of business must choose a costing system that suits its particular operation. No one system will serve every type of business. The operations of a business may be classified as either continuous or specific order. Continuous operations are typically those in which a single type of good is produced and the cost units are identical. Production involves a sequence of continuous or repetitive operations. Examples are manufacture of computers, production of mineral water, oil refining, production of medicines, passenger and freight transport. Continuous operations will almost certainly involve a product passing through a number of processes or different operations. For example, when making steel, the raw material will pass through a furnace, then be rolled out in sheets of metal and then cut to size. The final product would probably then be packed before being sent to customers. Specific order operations are those which are performed in response to special orders received from customers and may be classified according to whether the operations consist of individual job or the production of batches or identical units for a customer. Continuous costing. For a business with continuous operations, continuous costing is used to handle the cost of single unit of production or service. Unit costing. A single unit may be a single item, but the manufacturer of large volume of single products can probably more convenient to regard a number of methods as individual. For example, a company producing hundreds of thousands of packets of breakfast cereal, the unit may say 1,000 packets. Other examples of cost units are a pallet of bricks in brick making. A pallet is wooden platform on which a given number of bricks is stacked after manufacture and barrels for the output of oil wells. Specific order costing, job costing. For a company with specific order operations, that is, those which are performed in response to special orders received from customers. Job costing can be carried out. Each order becomes a cost unit and can be costed at a separate job. Examples of jobs are repainting a house, repairing a television, servicing it. This is one of the crucial advantages of cost accounting over financial accounting. As the costs have been classified for the job, the directors can focus on specific areas. In the financial account, these costs will be lost in almost all other labor and overhead, giving the directors limited opportunities to analyze the cause of any differences or plans for the future. Batch costing. Batch costing is very similar to job costing and is applied when an order for a customer involves the production of a number of identical items. All the costs incurred are charged to the batch and the cost per unit is found by dividing the cost of the batch by the number of units in the batch. You must be able to calculate a price report for a specific order. This was covered in section 28.11 and is again covered again here. This is a short chapter but nonetheless very important one. You should be familiar with the different types of costing involved in the definition of unit cost and batch costing. And you should understand the difference between continuous and specific order operations. Finally, you should be able to apply your understanding of these topics to prepare a quotation for results. Look back at section 28.11 and this chapter to make sure that you are able to work out something asked in the question. As always, with questions on costing, there is no set format to set out your answer unless financial accounting. There are some formats presented which may help, however, you may to set your answer, make sure it is clearly labeled and that all workings are shown. Margin costing. How to start and finish studying. Have a bird's eye view of the entire syllabus. Study each topic thoroughly. Never ever resort to shortcuts in study. Work out examples, illustrations, and exercises. Repeat until you understand. Practice exam questions. Practice mock exams. Simulate exam conditions and practice. Marginal costing. In this lesson, we learn everything about what marginal costing is, how it is used, concept of contributions and the contribution to sales is the concept of break-even point, break-even chart, application of marginal cost in pricing policy and deciding price, decide whether to make, sell, or buy from outsiders. Altogether, we discuss and practice questions based on these concepts, identify and work out examination problems. Marginal cost. In chapter 29, we saw how total costing can be used to determine price and profit. But beyond the business can be limited. In chapter 28, we identify classification of cost as fixed or variable. In this chapter, the distinction between them is important. The distinction is that variable costs increase in direct proportion to changes in the level of output. Within a certain rate, fixed costs remain unchanged as output increases or decreases. For many management decisions, it is necessary to know the marginal cost of the unit of production. Marginal cost can be described as the cost of making one extra unit of an item. It is based on the principle that an additional unit of production will only result in an increase in the variable cost and that the fixed cost will not be affected. Marginal cost of production is therefore the total of variable cost of production. Remember that both terms relate to the same thing. This is called a contribution because it is the contribution that each unit of the production makes towards covering the overheads and providing a profit. Marginal cost, the cost of making an extra unit of output, contribution, the difference between the selling price and variable cost of the unit or unit of output. In total, it is also the difference between the total revenue and total variable cost. See, in marginal costing, we prepare a cost sheet like this, variable costs, which will be direct material, direct labor, direct expenses, that will be the end cost. So to that, when you add variable overheads, you get marginal cost of production. So when you add fixed overheads to that, you get total cost of production. And when you add profit to that, that will give selling price. So what is contribution? Contribution is nothing but selling price minus marginal cost of production. So that is what is contribution. In other words, fixed cost is excluded to find contribution. The contribution per unit is calculated as follows. Selling price per unit plus the total of the variable cost per unit. The calculation of contribution either in total or per unit is an important aspect of marginal costing. I am sure that you are fully aware of what it is. Contribution to sales ratio. This is also known as PVR ratio. This ratio of the contribution to the selling price is known as the contribution to sales ratio. This is very important, useful ratio that can be used to calculate the answers to many problems. The use of CS, contribution to sales ratio, avoids the need to spend valuable time calculating marginal cost. The break-even point, the point at which a business or a product makes neither a profit nor loss is the break-even point. Managers need to know the break-even point of a product when making decisions about pricing, production levels, and other matters. Break-even occurs when total contribution equals total fixed cost or alternatively when total revenue minus total variable or margin cost equals fixed cost. It is found by dividing the total fixed cost by the contribution per unit. The calculation is the number of units that have to be produced and sold before the fixed costs are covered. When the calculation of a break-even point results in the fraction of the unit of production, the answer should always be rounded up to the next complete unit. For example, so 32,000 divided by 23, 1391.304. You have to round it off to 1392, not 1391, because a product cannot be a fraction. So it should be always the next number. Always indicate whether the break-even figure you have calculated is in dollars or units. The formula of selling price minus variable cost can also be extended to calculate how many units need to be sold to earn a required level of profit. break-even chart. A break-even chart is a dynamic representation of the profit or loss to be expected from the sale of the product at various levels of activity. The chart is prepared by plotting the revenue from the sale of various volumes of product against the total cost of production. The break-even point occurs where the sales line cuts the total cost line where there is neither profit nor loss. Suppose the marginal cost of a product exists $10 per liter. It is sold at for 22.5 per liter. Fixed costs are $50,000. This can be shown in the break-even chart as follows. So across this is the revenue, is the amount. Across this is the quantity, output in units. So across this you can see there is margin of safety, fixed cost, revenue, profit. So the break-even point is where the revenue and total cost line intersect. The break-even point. This is the point. The line AB shows the line AB shows the revenue at break-even point 90,000. So this is the break-even point. This is the break-even point, and the line BC shows the output in units. BC shows the output in units. So this is the quantity at which there is break-even. So beyond this is margin of safety. This is margin of safety. So this is the output units at break-even point. At 10,000 units, the revenue is 2,25,000, 225,000, 225,000, and total cost is 150,000, 150,000. The distance between those two lines shows a profit of $75,000, $75,000 the distance. So the difference between the revenue line and the total cost line before the break-even point represents the loss that will be made with the output cost below 4,000. Below 4,000, this is the loss. So the area beyond the break-even point represents profitable level of sales. Beyond the cost is profitable level of sales. The difference between the break-even point and 10,000 units is the margin of safety. Difference between this and this is margin of safety. So, or the amount where the output can fall short of 10,000 before the business risk, including the loss on product. We explain the number of units 6,000 or as a percentage of 60%. 60% margin of safety is 60%. Profit volume charts. Break-even charts may also be drawn to show only the profit or loss at each level of output. The cost and revenue lines are omitted. The break-even chart for product is given in the example. Above could be drawn as a profit or volume chart. Profit volume chart for product is zero output. The loss equals the total of the fixed cost $50,000 and 10,000. The profit is equal to $75,000. Straight line joining 2 points intersect the output line at the break-even point. Make sure that if you are asked to prepare a break-even chart, you don't prepare a profit volume chart or vice versa. The limitations of break-even charts. Break-even charts are useful visual aids for the study of the effect of changes in input cost and revenue at the break-even point, especially for managers with little accounting knowledge. The charts, however, have their limitations. It is important that you know the limitations of break-even charts. Try to learn them thoroughly. If revenue and costs are represented by straight lines, there may be a misleading. Minimum revenue may also be achieved if customers are given attractive discounts. While variable costs may be affected by quantity discounts when output is increased. These factors would be more accurately represented on charts rather than the straight lines. Some costs may be semi-variable. In other words, there is both an element of fixed cost and an element of variable cost included in the cost in the total. An example of this is the telephone. The fixed element may be the line rental, which must be paid whether any calls are made or not. The variable element would be the call charges, which will increase each time a call is made in order to break it to work. The fixed and variable element must be calculated and with the appropriate figure. The chart can explain people whose accounting knowledge is limited, but trained accountants will know how when to make allowances for a chart's limitation. Many fixed costs are fixed only when certain limits and may increase with the level of activity. They are fixed costs or semi-variable costs. In order to prepare a break-even chart or work out the break-even point, it is essential to use both fixed and variable. Sometimes you will not be specifically told that certain costs are semi-variable. where for two different levels of the other costs have two different values in total and per unit. Marginal costing and pricing. The price at which a good may be sold is usually decided by a number of factors. The need to make a profit, market demand, a requirement to increase market share for a product, maximum utilization of resources, competition from other firms, economic conditions, political factors, price regulation, and so on. Marginal costing can help management to decide on pricing policy, but first it is necessary to understand that some expenses, such as selling expenses, may be variable. An example is sales totals commissions based on the number of units sold. When variable selling expenses are included in marginal cost, result is the marginal cost of sales. So we can see direct material, direct wages, direct expenses, that will be marginal cost of production. Variable selling expenses will be marginal cost of sales. Other fixed expenses will be total. It is important to use the correct marginal cost when using marginal cost for decision. Acceptance or order below normal selling price. There are occasions when orders may be accepted below the normal selling price. There may be considered when there is a spare manufacturing capacity and in the following circumstances. And the order will result in further contribution to cover fixed expenses and add to profit. To maintain production and avoid laying off of skilled workers during a period of poor trading to promote a new product. To the stage of flowing or redemption inventory. The rule is that the selling price must always exceed the marginal cost of production in president. Then each unit will be sold at a loss before taking fixed cost into account. Acceptance of orders below normal selling price. There are certain occasions when orders can be accepted below the normal selling price. These need to be considered when there is a spare manufacturing capacity and in the following circumstances. When the order will result in further contribution to cover fixed expenses and net profit, to maintain production and avoid laying off skilled workers during the period of poor trading, to promote a new product, to dispose of slow or redundant inventory. The rule is that the selling price must always exceed the marginal cost of production. If it doesn't, then each unit will be sold at a loss before taking fixed cost into account. Fixed expenses will not be affected by the additional production. If you are told that fixed cost will also change, remember to take this into account in your calculation. The question here is whether the order should be either it will accept either of the orders. Make or buy decisions. We already seen in chapter 20 that the manufacturing account is that it should be to be more profitable for a business to buy goods from another supplier than make the goods itself. This was make or buy decision. It may be relevant for the goods that are already being produced or that introduction is immediate. The decision will be based primarily on whether the cost of buying the goods from another supplier is more or less than the margin cost of production. Notice that the margin cost of sales is not relevant to this type of decision, as any variable selling cost will have to be incurred when goods are manufactured or produced. The principle in this situation is that if marginal cost of production is below the price quoted to the supplier, then the offer should be reduced. Making the most profitable use of limited resources. Anything which limits the quantity of goods that a business may produce is known as limiting factor. Limiting factors include shortage of material, shortage of labor, shortage of demand for a particular product. When faced with limited resources, the company making several different products to use the limited resources in a way that produces the most profit. In a previous decision, the contribution per unit has been important factor in making the decision. However, when making the best use of limited resources, the product must be ranked according to the amount of contribution they make from each unit of the scarce resource. Production will then be planned to ensure that the scarce resources concentrated on the highest price. You may be asked to calculate the profit if there is no shortage of material and then divide profit taking into account the shortage of material. Seizing the manufacture of a product. Another important topic and one which is which marginal costing is important is the decision whether or not to cease producing a product. Sensitivity analysis. In section 30.3, the sensitivity of contribution profit break-even points to change in cost and revenue. This topic will not be covered in more detail as well as the estimates of revenue, cost, and profit. By definition, estimates are rarely likely to be accurate, and allowances should be made in budget for possible differences between estimates and actual cost and revenue. The point will be illustrated by taking an example of the high risk situation. Marginal cost versus absorption cost and inventory valuation. When we look at FIFO and the average cost, we saw that any difference in value including inventory will produce different profit. The two methods of cost, margin and absorption, will also produce totally different profits. The closing inventory value is two different. Advantages and disadvantages of marginal costing. Using marginal costing has both advantages and disadvantages. They are separate below. Advantages of marginal costing. The technique is easily understood. The reason is that fixed costs are not included in the cost of production and there is no arbitrary operation in the fixed price. Contribution provides a reliable measure for short-term decision making. Marginal costing shows clearly the impact on profit of fluctuations in the volume of sales. Under absorption, over absorption, overheads are not a problem and there is no need to calculate overhead absorption. The marginal costing technique can be used with standard cost. The technique shows the relative contribution to profit recognized by each product and shows where the sales effect will be contract. Disadvantages of margin costing. The disadvantages of margin costing are perhaps the biggest disadvantage of margin costing is that only useful for short-term decision making. Not all costs can easily be split into fixed costs and variable costs. Under margin costing, the fixed costs remain constant and variable costs vary according to the level of activity. In reality, the fixed costs do not remain constant and variable costs do not vary according to the level of activity. In the long run, all costs are variable. In the case of loss, the fair is result is varied using margin cost. The full amount of loss cannot be reported in the insurance company, signaling the factory fixed overhead to insurance. The management should not base decisions using contribution alone. The contribution may vary if meted of policy production terms. Leading on from this, the technique assumes that the production method will remain constant. In practice, this is not the case. Investment in new machines at the expense of reducing labor using the cost structure continues. It is really only useful or for a business which single product. The company several products will have difficulty allocating fixed cost to each product and limit degrees of so this will make it difficult to calculate the break-even point for either a single product or the business together. On balance, it may seem that the advantage and the disadvantage of marginal costing are greater than the advantages. As we have seen, though, marginal costing is widely used for short-term decision making. This chapter has covered the basics of margin costing, including what margin costing, how is it used, including how to decide on pricing policy for make or buy decisions and deciding how much is the most profitable use of sales resources. The concept of break-even is an important one for business, and in this chapter we have learned not only what to do, but how to calculate it and how to prepare a break-even chart. You have to learn about the importance of contribution and contribution to sales ratio, the use of calculation of sensitivity ranges, how to value an increase in and such. You should also learn what happens when orders from customers below the normal limit. Once again, there is no set layout when answering questions in this topic. Try to use tables for the answers. Setting things out in ways used in this chapter. Always make sure you fully label everything and show all your ratings. Is an important topic area, so pay careful attention to it and work logically through practice questions.
Dear friends, welcome back to Shasha's virtual classroom. So today we'll be doing practice exercises from credit transactions. And this is from David Hopkins. Uh, Suppose the following transactions in the books of Gerard. Okay, so if it helps, write down the names of accounts. So if it helps, write down the names. These are tips. Okay, so these are the tips. So write down the names of accounts you should debit or credit before you start posting the transactions to them. Work out the amounts of trade and cash discounts before you post them to their correct accounts. So first, let us calculate the amounts. So trade discount, purchase goods from car which cost $3,000 less trade discount of 10%. So 3,000 minus 10% is $2,700. So then sold goods to $600, it will be like that only. So return goods which had cost by rod 200 less discount to car. So 200 less discount. So it was you had sold here, right? So car. So you had sold here. Now So it is being returned. So 20,000 200 less 10% is dollar 180. 200 minus 10% is 180. So purchase goods sum which cost 200 before trade discount of 10%. So before trade discount of 10% means so again it will be dollar 2800 minus 10%. 2800 minus 10% is minus 280. 2800 minus 10%, 2520. So it's 2520. So trade discount is never recorded. Remember that. So trade discount is never recorded. So it is 2520. Sold goods switch in for 1300. So no discount here. Law return goods which had cost him $200 less. So this is lie. We have sold for 600. Lie return goods which cost him $200 less discount. We did give lie any discount. So have we given any discount to lie? No. So then this will be as it is. So $200. So there is no discount. It was not given. So it will not be given again. So it will never be given. So even though the question says like that, but we are not supposed to suppose, because here they are not mentioned whether we have given them any trade discount. Or it may be that there is a mistake. There is a mistake, printing mistake. So if that is the case, then less, because everywhere it's 10% trade discount. So let us consider it's 10% trade discount. It will be $540. So we should record. So here it will be lie return which it cost 200. So minus 10% will be $180. Okay, then Gerard paid car and limb the amounts due to them after deducting 5% cash discount. See, so many big calculations are there. Lai and Chin paid Gerard the amount they owed him after deducting 5% cash discount. So again you have to calculate. So how do you calculate? So wait, let us see how to calculate. So there is space here, so we'll write down. So Gerard, okay, so Gerard. These are the books of Gerard only, right? These are the books of Gerard. Gerard paid Khor. So we are paying to Khor. So remember, whose books? Gerard books. Gerard will never come. So Khor and Lim. Okay, Khor. Khor, how much we have to pay? Khor we have sold 2700 minus we have returned. He has returned 27180. So 2700 minus 180 is equal to 2520 we have to pay minus 5% cash discount. So this will be recorded. So this is cash discount. We recorded. So that will be how much? Minus 5. 2394. 23. What is cash discount? Cash discount is 2520 5%. 5%. 126. minus 126 is equal to 2. Now core is over. So now lie. Sold goods to lie 600. Sold goods to lie. Core and limb. So limb again here limb. Core and limb you are paying. So limb you write here. Lie you write here. And the other one chin. Lie 600. How much has been returned? Lie 200. So 540 minus 180 minus minus 180 is 360 minus 5%. 5% is cash discount again. Cash discount. So that is equal to 360 minus 18. 18 is cash discount. So the net amount payable will be 340. Okay, then core and lie and chin paid their own. Lie and chin. Okay, so now limb. So limb. Where is limb? Core over, lie over, core over, limb. Limb is 2800. That is 2520. So are we returning anything? Rim. Is limb returning anything? Are we returning anything to limb? No, we are not returning. So 2520 minus 5%. So that is equal to 2520 into 5%. 126. 2520 minus 126, which is cash discount again. Cash discount. So that is equal to 2394. 394. Again same chin. So now chin. Where is chin? Chin is here. Sold goods to chin. So chin has not returned any goods. Okay, chin has not returned any goods. Only lie returned. Only there are purchase returns. We have returned to Mr. Gerard has returned to CA. Returned goods. Okay, so here you can see return goods which had cost Gerard rupees Gerard $200. Lai returned goods which had cost him 200. Lai we are purchasing. Okay, so there is one sales return and one is purchase return. Chin. There is no return by Chin. Sold goods to Chin means there is no return by Chin. So 1300 minus 5%. So that is nothing but 1300 minus 1300 minus 5%. $65. $1, 1, 2, 3. See, these are the calculations. So that is why it is advised that first you work out the trade and cash discounts before you post them to their correct accounts. So first, these are so many calculations. See, so many different calculations were there. Though this looks simple, some students make mistakes even in calculating this. So be careful. So then now we'll come to the main part. So which account will be debited by how much and which account will be credited by how much. So debit. Okay, so purchase goods from car which cost 300 less trade discount 100. So we are purchasing from car. So Gerard is purchasing from car. So purchases account will be debited. Account will be debited. Car account will be credited. Car account will be credited. So why car account will be credited? Because car is giving the goods. He is the person who is giving. Okay. So when we purchase, when Gerard purchased, car gave the goods. He is the person who is giving. This is the account that is giving the goods. Okay. So that's why his account will be credited. So amount will be 2700. Amount will be 2700. Same line. Okay. See. So now sold goods to Lai for $600 less 10% trade discount. Trade discount. So 540. So sold goods. So sales account. Sales is an income always. And who is receiving the goods? Lai is receiving the goods. So Lai account debit. Because he is receiving. Lai account will be receiving. So that is why his account will be debited and sales account will be credited. Sales account will be credited. Return goods which had cost Gerard 200 less discount to her. So return goods which had cost Gerard. So this is who is returning? Gerard is returning. So it is purchase return. So obviously when he returns, it will be purchase returns. So purchase returns will be exactly reverse of purchases. So purchase returns. Purchase returns. So how much? It is returned to Khar. So Khar is receiving the goods. No. When you are returning back the goods, Khar is receiving the goods. So he is receiving it. Khar account should be debited. So then, purchase goods from Lim which had cost 2800 before trade discount of 10%. So purchase goods from Lim. So purchase goods from Lim means purchase. Again, purchases is always purchases. Purchases account. Purchases are always purchases. So purchase account. Goods from Lim. So who is giving the goods? So lim is giving the goods. So lim account is created because lim is giving the goods. Okay. Sold goods to Chin for $1,300. Sold goods to Chin for $1,300. Sold goods to Chin. So Chin is receiving the goods. Chin is receiving the goods. Chin account debited. Sales account credit for this. So Lai returned goods which had cost him $200 less discount. Lai return means this is you have sold to Lai, no? Just see here you have sold to Lai and is returning the goods. Maybe they are defective. That's why Lai is returning. So Lai is giving. So you have to give, you have to credit whoever gives, right? So Lai account will be credited. And it is sales return. Sales return is reverse of sales, so it is debit. Sales return account. So then this is also done. Then now, so this is also over. So this is for this. Gerard paid Khor and Lim the amount due to them after deducting 5% cash discount. So when you are making, when Gerard is making the payment, who will receive? Khor will receive. So Khor will receive, Khor account, and Lim also will receive, Lim account, Khor account, debit, and credit what? Bank account. Bank account. But one more thing is there. What is that? Discount account is also there. Gerard paid Khor. So when Gerard is paying Khor, he is not paying certain amount, so which is cash discount. So it is discount received. So it's an income. So discount received will be credited. For Khor it will be 126. Okay. Khor it will be 126. And Lim it will be, again here also discount will come. Discount received will come. So here also it's 126. Both for Khor and Lim, discount received is 126. So bank account will be how much? Bank account will be 2394. What will be the amount? 2520. 2520 here also. 2520 here also. Khor and Lim. Khor and Lim. Khor, how much you have to debit? Khor you have to debit 2700. What is the discount? No, correct one. 2520. So this is trade discount. Trade discount will never be recorded. Trade discount will never be recorded. So it will be recorded at this. This will be recorded at this. Then Lai and Chin paid. So Lai and Chin paid means obviously money will come into bank. Bank account will be debited. Bank account will be debited. So Lai pays how much? Lai pays 342. Lai pays 342. We receive 342. So Lai, no? Lai account. and when we are receiving lesser the amount. So here there is no discount for limb. Lie returned goods which had cost 200 less return discount. Okay. Lie 342 we are receiving. So bank and discount received. Discount received is, it's not discount received, it's discount allowed, it's an expense. So when you pay short, it is expense. Discount allowed is like 18. So here it is 360. Live 360. So bank account. So here in this case it is 1235. So discount allowed is 65. Discount allowed is 65. So chin will be credited with this plus this. So that is 39. So now you have to prepare ledger accounts and post the amounts. Prepare ledger accounts and post the amounts. So start doing this. So it's very simple. So we already done this. So we can do the rest of the part. So if required, we can do it in the next class. So dear friends, last class I had given this assignment to you. This is assignment from David Hopkins. So this is very challenging because in this your concept of books of accounts of particular person is very much important. So accounts of one particular person is very important. Post the following transactions in the books of both Brian and Ken. See what is if for Brian the transactions will be different. For Ken the transactions will be different. Because if he is buyer, he is a seller, and if he is a seller, he is a buyer. So here it has been asked name of accounts to be debited, name of accounts to be credited. So you should not get confused. You should not get get it wrong. So you are not so see if you write books of, but here the question is you have to post the transactions in the books of both Brian and Ken. But here they have asked you to write name of account to be debited, name of account to be credited. But whose books? Is this whatever you are writing here, are these related to Brian or are these related to Ken? So what is the best remedy? Let us for the time being we will consider this as the books of Brian. And for Ken, we will write separately here. Okay, books of Brian. So what is Brian doing? We have to see from the point of view. So Brian sold goods. He is selling the goods. So it is sales for him. For Brian it's sales, and for Ken it is purchases. So when Brian sells, who will receive? Who is receiving? Ken is receiving. Ken is receiving. And when Ken is purchasing, who is giving? Brian is giving. So this concept should be very clear. Now, Ken sold goods to Brian. So sold goods to Brian. So sold goods to Brian means what is Brian doing? Brian is purchased. Brian is purchased. So it is purchases because these are the books of Brian, right? So you have to write it in the books of Brian. So it is purchases for. So if Brian is purchasing, who is giving the goods? Ken is giving. If for Brian if it is purchases, then for Ken it is sales. And the other side, it is Brian. So the understanding should be very clear, crystal clear. So don't get confused. Don't get confused. Brian sold goods to Ken. Again, sales. Sales. So again, it is Ken who is receiving. So if it is sales for him, it will be purchases for this. So here it will be Brian. Then Ken sold goods to Brian means Brian has purchased. So then Ken. If it is purchases for him it will be sales. So if it is sales this side, then who is receiving? Brian. Ken paid Brian for the goods he bought on. Ken paid Brian. So Brian is receiving money. He is receiving cash. And he is allowing discount because it is a loss. He is receiving less. Then who is giving? So obviously Ken is giving. When Brian is receiving, Ken is giving. So now Ken paid, no, simply that's all. So cash. Cash is going. And he's paying less. So if he pays less, it is discounted received. So it is an income. And to whom? To Brian. Brian paid Ken for the goods he had bought on 2nd April, let's say cash. So now Ben is paying. Brian has paid. Brian has paid. So cash. So he has paid less discount. So it is Ken. So here if it is discount received for him, here it will be cash and discount alone. And here it will be. So after doing this, you have to prepare the ledger accounts. Ledger accounts of Brian separately and Ken separately. So purchase account, how many ledger accounts will there? Purchase account, sales account, Ken account, discount received, cash account, all these accounts will come in this. And in this, so many accounts will. So we'll prepare the ledger accounts. Shall we prepare the ledger accounts? I will give it as an assignment to you so you can try on your own. So let me see and I will discuss this in the next class. Dear friends, last class we had discussed this problem. So you can see still on the screen. So it is as it is. So we will now enter the following, enter these, prepare ledger accounts for this. Post the following transaction in the books of book Brian and Ken. So we'll post the entries to ledger accounts of Brian and Ken. So how to do? So we'll proceed. So books of brand. Okay, so books of brand. So first we'll complete books of brand. So Ken will be debited with sales. First entry, Ken will be debited with sales. Ken will be debited with sales. Ken, Ken will be debited with sales. So sales. Ken will be debited with sales. So what is the amount? Let us see. So the amount is 1500 and date is equal. This 1500. So next, next one, credit Ken with purchases. Credit Ken with purchases. Credit Ken. Credit Ken with purchases. Ken with purchases. So what is the amount? So the amount is 500 less trade discount of 200. So 520% is with 400. And that is on April 2nd. April 2nd, 400. So purchases will be debited with 10. So now next. Brand can debit Ken with sales. So 800 plus 25% trade discount. So 600. Debit Ken with sales. Debit Ken with sales. Sales. 600. So what date? Third. Third April. So Ken you are debited. So what about sales? Sales also you have to accordingly you have to credit sales. Okay, next. Again, credit can with purchases. Again, credit can with purchases. Again, credit can with purchases. So, what is the date? Amount 920%. Sixth. Okay. Sixth. Hundred. 720. So, so purchases you have debit again. So can again. Now can pay Brian for the goods bought on 1st April less in cash discount of 3%. So credit can with cash and discount alone. Credit can with cash and discount. Credit can cash discount. Cash and discount alone. So credit can with cash and discount alone. How much? For goods he bought on 1st April. He bought for 1500. So he got a discount of 3%. So 15 3 is 45. So discount alone is 45 and rest is paid. The rest is paid. Rest is 145. So what date is it? It is on 10th. So cash it has to come. Cash column it has to come. So this one advance paid can how much? then discount allowed. Where is discount allowed? Discount allowed in the loss. So from this side. Then what is the amount? 45. 45. And what is the date? Next. Brian paid Ken for the goods he had bought on 2nd April. So debit Ken with cash and discount receipt. Debit Ken with cash and discount. Debit Ken with cash and discount. Debit Ken with cash, discount, receipt. So what is the date? What date? So 12. So now what is the amount? The amount is for the goods you bought, let's say cash discount on 2nd April. 2nd April you bought for 400 minus 5%, 20. Discount received is 20. Balance is cash. Discount received is 20. Balance is cash. This is how it is. So these are the books of RAM. This is how you have to record. Similarly, so now we can see how it looks. So you can just put it down, or you can just have a look. So discount received. Discount received doesn't even also there. Discount received doesn't even also there. Cash. Cash also is there. So here we have to complete the entry. So equal to, so Ken complete the double entry. Always complete the double entry. Discount received. So date is same. Amount is also same. Okay, so I would like to mention that all these things are very simple, but very basic and very important. Unless these concepts are clear, going ahead you will get confused in a lot of other concepts. Lot of students they ignore these topics. They take it for granted, like it is just easy and we have understood something of it. But afterwards, they get some concepts wrong. So teachers are not tools to teach you unnecessary things, redundant things. They are teaching with a purpose. The books are not written just to fill up the pages, but with a purpose. So please follow it strictly, do it sincerely, study sincerely. So now, books of Ken I will leave it to you. If you want me to do even that part, please make a comment in the comment section of the video. I will do it. Otherwise, I am not going to do that. It is assumed that you have understood it. So till then, bye bye. Hey, remember, I'm a trainer, not a tutor. I train you to pass, to succeed, to clear your exams, to get better marks, to excel in your studies, so that you understand and do better, better and better and best, the best. It's okay. I've been taking on classes. I'm aware of difficulties faced by various students, below average, above average. I analyze and understand what they don't really understand and how the students suffer. I feel their pulse and try to understand their difficulties, making the student understand the subject and making interesting for them to learn so that they excel in their studies is my core perspective. These days, a lot of students have various difficulties. They won't understand anything in the class. A lot of students who are pursuing online classes. A lot of students who are taken up distance learning classes face various difficulties in understanding the core concepts. So they try to understand, but most of the teachers uh, have different methodologies to explain, and few students are unable to understand. It's a hard time for the students. Myself, not being just learned, but having understood the subject as a common sense, I'm a professional tutor, professional trainer, and educator, having on-job experience and theoretical knowledge in various subjects, such as direct taxes, indirect taxes, accounting, be it financial accounting, advanced financial accounting, cost accounting, advanced cost accounting, managerial accounting, advanced managerial accounting, management accounting, advanced management accounting, financial management, operations research, quantitative techniques, business mathematics, business statistics, business economics, business studies, and various other business management subjects. I even have on-hand experience in ERP, SAP, Tally, QuickBooks, and all. So I'm in a better position to explain the real logistical issues, the logistical problems, the core concepts in a better way. So a lot of students approach me near the exams for exam-oriented crash courses and exam-oriented coaching so that they pass their exams. I have a record 100% of my students clear my exams, clear their exams with ease. 100% they succeed. So I explain them as if they are novice. Ignorant novice. Even the ignorant novice understands the subject easily. So I teach them as a common sense, because any subject is more a common sense than a subject. So a student should be capable of understanding the concepts so as to make their life easier. So learning becomes pleasure and enjoy. So anyone who is interested, who wants to clear their exams with ease, without any difficulties, may please get in touch with me. I am available anytime for them. 24/7, I am available for them. Thank you. Sharing is caring. So please subscribe, share to my channel, because spreading knowledge only increases your knowledge.
Dear friends, welcome to Shasha's virtual classroom. So today we will work out problems from books of elementary. So in this lesson we will learn how we record books of elementary, how to prepare books of elementary. So this is a problem from David Hopkins. So Murugathayat had the following transactions all on credit March. So purchase goods from Piccolo for $10,000 less trade discount of 20%. Piccolo allowed him 5% cash discount. Sold goods from Snyman for $1,200 less trade discount of 10%. He allowed Snyman 4% cash discount. Purchase goods from Walters rupees 8,000 less trade discount of 10%. Walters allowed Mukudai 5% cash discount. Sold goods to Tar for $10,000 less trade discount of 10%. He allowed Tar 4% cash discount. Snyman returned goods which had cost him $200. Returned goods which had cost $400 to Piccolo. Purchase goods from Burger for 7,000 less trade discount of 25%. Burger allowed him cash discount of 4%. Sold goods to Kodzak for $3,000 less trade discount of 10%. He allowed Kodzak 5% cash discount. Purchase goods from Piccolo for $6,000 less trade discount of 20%. Piccolo allowed him 5% cash discount. Target return goods which had cost him 300. Return to Burger goods which had cost $1,000. Sold goods to Simon for $1,800 less trade discount of 10%. Trade allowed 5 5%, 5%. Received checks from Simon, Garg, and Coates respectively in full settlement of their accounts. So, accounts receivable are free and send checks in full settlement of their account to Piccolo, Walters, and Berger. So then, enter the transactions for March in the books of payment and post them in good form to the proper account. The transactions should be dated, however, for the purpose of activity. Ignore the dates and post the transactions to the correct books, the correct journal, and the correct ledger accounts. So we should record this in the books of prime entry. So where should we record this? So what are the books of prime entry? Purchase goods, purchase register, sold goods, sales register, purchase goods, purchase register, sold goods, we have to record in sales register. Snaiman return goods, so Snaiman, who is Snaiman? Obviously customer. So sales return goods which had cost to Piccolo. So return goods to Piccolo, purchase return. Purchase goods from this is purchases goods. Purchase register. Sold goods to code the sales register. Purchase goods from Piccolo, purchase register. Car return goods which are costing 300. Car return. Who is car? Car is so obviously it will be customer only. So sales return. Return to burger. So purchase return. Sold goods to finance sales register. So received checks from Simon, Karg, and Kodje. So we have to record in type for the payments and for the amount received and for the amount we have paid. So now we have to record it. So how do we record it? The first entry. So we'll record entry wise. So first entry, purchase goods from Piccolo for 10,000 less trade discount of 20%. So we don't record trade discount. So we never record trade discount. We have to record the transaction at that amount. So that is at 80,000. So 10,000 10,000 20% is 2,000. 10,000 minus 2,000 is 8,000. 8,000 we record it in purchase register. So purchase register Piccolo 8,000. Purchase register Piccolo 8,000. Okay. So similarly, next sold goods to Simon for 1,200 less trade discount of 10%. So sold goods to Simon. So we have to enter in sales register. So 1,200 trade discount of 10%. So sales register Simon. So date particulars it is Simon. Simon. Sold business Simon for 1,200 less than trade discount of 10%. So we have to record like this. So everything we have to record in each and every book respectively. So sales register will look like this. So Snyman 1080, Card 2250, Odds 2700, Snyman 1620. So you can see. So it is Snyman sold goods to Card, sold goods to Kodze, sold goods to Snyman again. So 4 sales entries are there. So we have to record it in this particular style we have to record. So this is known as format or whatever. So we have to record in this particular way. So the transaction should be recorded in this particular format. So format is important. So then the next one we have to record in purchases. So we have done purchase entry. So that's so purchases will look like this. So we have purchased from Piccolo, Walters, Burger, and Again from Ticolo, 4800. So we have to enter in purchase journal like this. So take some time to write it down. Then we have to enter in sales return register also. So sales return register, what do we write? So whatever sales we have returned, all those entries. So what is it? Let us see what is the sales return. So Snyman return. Snyman, we had sold to Simon. So Snyman return, which had cost him 200. Snow 200. So Snyman 200. So like this, similarly, we have to record all the sales returns. Snyman return, car also return, car also return. So Snyman and car we have to enter. So the entries will look like this: Snyman 200, car 200, 300. So similarly, purchases also we have to record. Purchase returns also we have to record. So what are the purchase returns? Purchase returns are returned goods which have cost 400 to Ticolo. 400 to Ticolo means obviously Ticolo has given 20% trade discount. So which had cost him 400 means that is the net discount before discount, which had cost $400 to Piccolo. So that is before discount. So we have to take after discount and we have to record it after discount. So returns, purchase returns we have to record after discount. So it's not 400. So it is $320 and burger is 1000. So we have to record it net of discount. So we have to record in sales register, sales journal, purchase journal, sales return journal, purchase return journal. So we have to record in all the journals. Then ultimately we have to record in cash book for the payments made and received. So what are the payments that are made? So after doing all these entries we have passed. Purchase goods. So purchase goods from Ticolo we have passed. All these entries have been made. All these entries have been passed. So now last entry receipt from check. Receipt checks. So we have to consider the discount also. The discount part, everything we have to consider. So let us make the working. So here it is. So Snyman, we have sold to Snyman worth this one. These are the returns. Total again we had purchased, again we had sold worth this one. So total amount is 2500. So totally 2500. He has given a discount of, we have allowed him discount of 5%. So the discount amount is 125. So the net amount 2375 we will be receiving from him. So I made all the amounts, list of amounts. So these are all sales or purchases. So these are all sales. This is also sale. These are all sales returns. These are all purchases. These are all purchase returns. These are purchases. These are the cash discount. This is cash discount. This is cash discount. So this is percentage of cash discount and this is amount of cash discount. So the net amount ultimately received or paid is coming here. So we have to do like this. So first we calculate. So this is the amount, net amount. These are the amounts that are received, and these are the amounts that are discount. So we have to write it. So where do we write? So all these three guys have paid. Three guys have paid. So how much they have paid and what is the discount? We have allowed them a discount. This is the discount we have allowed. This is the amount we have received. So all these amounts we have received. And we have paid these three people. These three people we have paid. And we have got discount. These are the discount values. If we calculate, so ultimately the payment, the amount we have paid, So this is how the cash book will look like. The amounts we have received from accounts receivable, the discount we have allowed, the cash we have received, the discount we have received, the cash we have paid. So this is what is cash book, and cash book will look like this. So this we have to record, and that is also done. So now what all we did? So we entered, we recorded, we prepared sales register, we prepared sales register, we prepared purchase journal, we prepared sales journal or sales register, sales journal we prepared, we prepared purchase journal, we prepared sales return journal, we prepared purchase return journal, and we have prepared cash book also. We have prepared cash book also. So now what is left? So now we have to prepare ledger accounts. So what are the ledger accounts? We have to prepare all the ledger accounts of all the parties. So sales account. Sales account is always a credit balance. So we are not supposed to record each and every entry. We have to record the total. We have to record the total in sales account. So sales account we have to record the total. So first let us do the total. So this is the total of sales, total of purchases, total of purchases, sales returns, sales returns, purchase returns, sales. So how do we record? So come to ledger. So sales always is a credit balance by sales journal we have to record here. So how much is it? We have to record this here. So then sales return. Sales return. Sales return is reverse of sales to sales return journal. So sales return journal purchases account. Purchases is always debit. So two purchases journal So total amount, purchase is journal. This is the total amount we have to record here. So remember, we should never record individual entries in purchases account. So we have to record the total. Then purchase return. Purchase return is reverse. So journal, purchase return journal. So we have to record like this. Now we have to record entries related to Piccolo. So how do we record entries related to Piccolo? So who is Piccolo? Piccolo is a customer. Piccolo is a supplier, his accounts payable. So we have to credit him. So purchase. Purchase we have to record. Piccolo. So how much? Piccolo 8,000, 4,800. So purchase return is also there. What is purchase return? Purchase return is 320. Purchase return is 320. So purchase return is 320. So then we have paid. So we have got some discount. Discount received is 624. So amount we have paid. Amount we have paid is cash. How much we have paid? So you can see the cash book. 11856. So we have to see here and then you can pay. So 11856. Now let us just check. So now if we add all this, so that will be okay. So finally we have paid everything. So this is how the each and every account will look like. So you have to we have to do the posting. So then accordingly we have to uh, prepare all the ledger accounts. So now we'll prepare ledger accounts. So we have to see the transactions and then accordingly we have to prepare. So Piccolo we have purchased we have purchased from Ticolo, and there was purchase return of 320, and we have received a discount, and ultimately we have paid. So this is how we have to record, seeing the debit side, credit side very carefully. Then Ticolo's account is over. Now we have to prepare Snyman's account. So Snyman is a customer. We have sold goods to him. So we have sold. We have returned also. So we have received. We have allowed a discount, and we have paid. So what are the amounts? Sales, sales, sales return. So the discount allowed, cash. So Snyman's account is also done. So now Walter's account. Walter is a supplier, is a accounts payable. We have purchased from him. So these are the purchases. We have received discount, and we have paid cash also. So the discount we have received is 360, and cash we have paid is 6,840. So we can see from the cash book. Then again burger also we have purchased from burger. So 5,000 to 250. So there are purchase returns as well. So we have paid cash to burger. So what is the discount? Is there no discount? There is a discount, so we'll just see. Then let us first finish this. So remember burger account, there is we have to record purchases. So then cards, car. So we have sold goods to car. So we have to enter sales. We have to prepare car account. We have even made the sales return to him. So we allowed him discount. So we have to record that. And we have paid, we have received cash. So even that we have to record. Then cards account, he is a customer, we have sold him. So 2,700, and we have allowed some discount, and we have received the balance amount from him. So done. So what is left? Burger account. We didn't give discount. Let us check whether we didn't give discount. We received discount from burger or no. Burger, yes, 170. We paid him 4,080. Burger, we received discount of 170. We received discount of we received discount of 170. So 170. So cash we have paid. So this is the amount of cash we have paid to burger. Then which account is left? We have to prepare discount allowed and discount received. We have to enter discount allowed and discount received. So discount allowed from whom and all we have received. So let us see. Discount allowed. We have allowed discount to these three people. Receivables. We allow discount to account receivables only, right? So we allow discount to receivables only. So we allow discount to these three people. And discount allowed is always a loss expense. And what is the amount? Amount also we can just note down from here. What is the amount? We These are the amounts. These are the discounts that we have allowed. So, and we have received discount from accounts payable. We have received discount. So we have to record here. So it is an income. So we will credit it. So who are the payables? Who are the accounts payables? These three are accounts payable: Ticolo, Walter, and Berger. Ticolo, Walter, and Berger are three are accounts payables. So we have received discount from them. So the amount is this. So the amount is this, this, and this. Okay. So this is how we have to see the chapter is very simple, that unless otherwise you do all these things, unless you do all these steps, your understanding will not be clear. Your understanding of the subject will not be clear, and ultimately will get stuck in accounts receivables, accounts payables, even the advanced entries, whatever are required. At that time, you get stuck. So they look very simple. So at least one or two problems you have to do. So kindly ensure that you do this problem without fail. So then this is done. So what I do is uh, I will give this problem as assignment to you. So this is also from David Hopkins. So you can just try this problem on your own. So then, if you have any doubt, you can let me know in the comments. I will help you work out. I think you can do it on your own. So I am 100% sure. So please try and finish it. So we can move on to the next next lesson. So this is very simple. So one or two problems are more than sufficient. So if you want, you can do this. So if you let me know as a comment in the comment section, I will definitely do it. Otherwise, I will assume that you have understood and it's very simple. So we'll move on to the next lesson. So next lesson is how to balance the accounts. How to balance the accounts. That is what we are going to learn in the next lesson. So till then, bye bye. Dear friends, so we'll continue with the books of primacy. So this is another column which is there in David Hopkins. So prepare journal entries with suitable narratives to record the following. So prepare journal entries only to ledger accounts, never to other books of prime entry. See here, journal entries with suitable narratives to prepare journal entries only to ledger accounts, never to other books of prime entry. Received from Mumtaz, invoice number 506, dated 3rd March 10,000. This was in respect of the purchase on a machine on credit. So this is the purchase of machine on credit. Okay, so it is purchase of machine. Machine is an asset. So it is not purchases. So it will not be recorded in purchases account because it is not purchase of merchandise. So it will be recorded in journal. So the entry will be recorded as machine account debit to Mumtaz. Why? Because we are purchasing from Mumtaz. Okay, we are purchasing machine from Mumtaz. So the entry will be machine account debit to Mumtaz account. Account debit to Mumtaz account credit. So the amount will be, so what is the date? Date they are not mentioned. So they have mentioned just A. Okay, invoice number 506, purchase of machine on credit. What is the amount? Amount is 10,000. $10,000. 10,000. So you have tried the narrations. Machinery purchased on credit, wide invoice number 506. That's all. So we have to record it. So it will not go to purchase account. So no subsidy books of primary entry, book of primary entry. So we have to record it in journal proper. So next, invoice number 495 dated 6th March, sold to Wayne. Goods sold to Wayne. The invoice has been entered twice in the sales journal. So has been entered twice, has already been entered, but it is entered twice. So we have to pass rectification entry. So what is the entry when we make the sale? When we make the sale, the entry will be Wayne to sales. So now you have to reverse the entry. Wayne to sales. Now it will be sales account to Wayne's account. So the amount is 675. Sales recorded twice. Now reversed and rectified. So this is also done. Next entry. So then we'll see what is the next entry. Invoice number 998 dated 7th March for 4,250 in respect of delivery van purchased on credit from Yunus and paid by check. So delivery van purchased on credit from Yunus. Delivery van purchased on credit from Yunus. So 40 to 50, 4,250, 4,250. But you see, what is the entry? What is the question? Invoice number 998 dated 7th March 4,000 respect of delivery and purchase on credit from Yunus and paid for by check. So there is a check payment also, but we should never record check payment because check payment will be recorded in cash flow. So only first part, which is purchase on credit from Yunus, only that will be recorded. So remember, if you record, if you write payment entry, then it is wrong. Grave error. So never do that. Okay. So accordingly, you have to be very careful when writing the entries. So all these entries which never come in any of the other books will always come in journal proper or general journal. So this is general journal where we are recording, because none of these entries are capable of being recorded in any of the prime, neither in the sales book nor in purchases book, neither sales return nor in purchase return nor in cash book. So other than that, whatever is there, that should be recorded in journal proper. So next, credit note number 103 dated 10th March 1 for $190 sent to Brownie but omitted from the sales return journal. So you have given credit note but you have not recorded in sales return journal. Now you record it. That's all. So sales return journal. So what? How do you record it? So what will be the entry? The entry will be, you have to write down in sales return journal, and then the next step is you have to write down the journal entry, that is you have to record the entry. So how do you record? Sales returns account debit to Brownie account credit. So you have to credit Brownie. Sales return account debit account debit to Brownie account credit. What is the amount? 190. Yes, 190. So you can write the entry full narration. So 190. So it's narrative. So you can write down full narrative. Sales returns now recorded. Sales returns now recorded. Sales returns. Next. Invoice number 854 dated 15th March 1300 for goods purchased from Sandra. The invoice has been posted to Geeta's account in error. So what has happened? It has been posted to Geeta's account. It is entered in purchases account, but the posting has been done wrong. The posting is wrong. So instead of posting to Sandra, the posting has been made to Geeta. So it is purchased from Sandra. So you should have credited Sandra. Instead of crediting Sandra, you have credited Geeta. So what you have to do? You have to credit Sandra and debit Geeta. So the entry will be Sandra account debit to Geeta account debit. So the entry will be Geeta account debit to Sandra's account credit. Geeta account debit. Account. amount wrongly credited to credited to Geeta. No rectified. So now rectified. So this is how you have to pass the rectification entries. So here you can write. See, it should be in debit column. This should be in credit column. Machine account debit, Toyota's account credit, sales account debit, Royal's account credit, delivery van account debit, Yuna's account credit, sales returns account debit, Brownie account credit, Geeta's account debit, Sandra's account credit. What is the amount? So the amount is 1300. Amount is 1300. So all these are rectification entries. So if you observe, all these are rectification entries. None of these entries will come neither of the books of prime entry, neither in sales register, sales this one journal, nor in purchase journal, nor in sales return journal, nor in purchase return journal, nor in cash book. Neither of the books that will come in the residual book, that is journal proper. So carefully you have to do this. So this is how we have to record. So this very important aspect. So the entire chapter is based on this suspense account, rectification, suspense account. Lot of questions are asked in AS level. IGCSE also a lot of questions have been asked. So you have to be very thorough in this aspect. The debit and credit aspect you have to be very thorough. So we'll catch up in the next class. Till then, bye bye. Dear friends, these are exam practice questions from books of elementary. So this is again from David Hopkins. So let us discuss this. So exam practice questions. So this is basically number one. Tanya purchased goods for 1000 less 25% trade discount. So trade discount is never recorded but should be considered. So that is 1000 minus 25% is 250. She was allowed a cash discount of 10%. So cash discount will be considered at the time of payment. So entry will also be passed. What amount should she enter in her purchase journal? Purchase journal she has to record 750. So discount is never recorded at the time of purchase entry. Trade discount is recorded. Trade discount is recorded, but cash discount is not recorded at the time of in the purchase journal. It is not recorded in purchase journal. Next, Nara purchased goods costing 1800 less trade discount of 30%. So 1800 minus 30%. So that is equal to 1800 minus 30%. 1260, 1260. So that is 1260. Okay, so She was allowed a cash discount of 5%. She was allowed a cash discount of 5% means she has to pay less. So how much she has to pay less? She has to pay 63 less 5%, no? 5% of this. So 63 less. So this one. This should be how much should Lara have to pay for the goods? It is 1197. So when we subtract this and this, it is 1197. So this one done. Next. See, these are exam style questions. So similar questions have been asked in the AS level examination. So these are not A level A level questions, but AS level. So, but IGCSE also they have been asked several times. So then coming to this, Cora sent an invoice to Maria for 2000 less 20% trade discount. So Cora sent an invoice to Maria for 2000 less 20% trade discount. So okay, so 20,000 2000 less 20% trade discount is 2004 1600. So 1600. So trade discount will be considered, but never recorded. So we have to take the net amount. So 1600 it should be recorded at 1600. Cora has omitted to enter. She has omitted. Okay, Cora has omitted. So has sent an invoice means she has sold. To enter in her sales journal. She has not entered in the sales journal. So obviously what will happen? Sales account will be understated by 1600, not 2000 because the trade discount will be recorded. So even Maria's account also will be understated by 1600. The answer is so then come this one. Shiung has received a check of $1540 from Raju in full settlement of a debt of 1700. How should this be recorded in Shiung's book of account? So what has happened? Chung has received a check. So he has received a check of 1540 from Raju in full settlement of 1700. So there is a discount factor. There is a discount factor of 1700 minus 1540 is 160. So this should be recorded. Discount allowed should be recorded, and it should be recorded. How should this be recorded in Chung? So nowhere this should be recorded. Bank account this should be recorded, and this should be recorded. We have to consider as if we have received full money from this guy, so the entry will be this one. This one will be the entry. So accordingly, the debit and credit aspect should be very very clear. So practice these questions again and again. Often more and more questions you have to practice. So maybe a lot of MCQs we can discuss in the meantime. But before that, let us go through the entire syllabus so that the concepts are clear. Otherwise, just by solving the question papers or just by working out the question papers near the exam is not sufficient. Remember, slow and steady wins the race. So never ever think of shortcuts. Never resort to shortcuts. Start studying from day one. So start studying from the day one. So let's catch up in the next class. Basically, the next class is how to balance the accounts. Till then, bye bye. Dear friends, welcome back to Shasha's virtual classroom. So this is balancing of accounts. So this is a question from David Hopkins. So basically, it's a very small question. So, but in this lesson, we'll learn how to balance an account. So balancing is nothing but totaling up all the values and then finding the difference and putting it on the right place. So that is what is balancing of accounts. So this is the last step before preparation of trial balance. After this, we will be preparing trial balance. So before that, you should know how to balance the ledger accounts, because trial balance is prepared on the basis of balances of ledger balance, the ledger balances of ledger. So in this question, this is a small question. So first, let us make a list of debits and credits, so that our writing the ledger entries will become easier. So let's classify and write which account will be debited, which account will be credited in each case. So paid into savings, paid is savings into business bank account 10,000. So bank account, money is coming in bank account and capital. So bought goods for resale on credit from Joe. Bought goods, so purchases on Joe. Paid rent of a shop by check, rent, bank. Sold goods to Barney on credit, sales, Barney, sales. Made cash sales of goods, the money was used to set up cash flow. Made cash sales of goods, cash sales. Return faulty goods to Joe, returns. Return to Joe. Joe paid by check for the goods he had bought after deducting a cash discount. So Joe has paid means paid Joe by check. So we have paid to Joe and we will receive a cash discount. So this is discount received. So then by check means obviously it's bank. Then paid for postage by cash. So postage. Cash. So now we have to prepare all these accounts: bank account, capital account, purchases account, Joe account. So ledger accounts, prepare necessary ledger accounts. 3-column cash book. 3-column cash book to record the transaction. So most of the entries will come in cash book also. So and some entries will come in ledger accounts. So then balance the accounts at 31st March and bring down the balances. So we have to balance also. So then what we'll do? So we'll start preparing all the accounts one by one. Okay. So capital account, purchases account, Joe account, rent account, Barney account, postage account, sales account, purchase returns account, and discount received account. So all these accounts we have to open. So now What is the first entry? Paid his savings into business bank account 10,000. So that is on March 1st. So March 1st, bank account should be debited with capital and capital account should be credited with bank account 10,000. March 1st. Capital account should be debited with bank 10,000. 10,000. So then credited, capital account will be credited. So capital account will be credited on March 1st. March 1st. So bank account 10,000. Then first entry is completed. Bought goods for resale on credit from Joe. Bought goods for resale on credit from Joe. So that is on March 2nd. Purchases to Joe. March 2nd. Purchases purchases sorry purchases account should be debited with Joe. Joe account. And Joe's account should be credited. So purchases. So what is the amount? Amount is 4,000. 4,000. 4,000. Then what is the next entry? Paid rent of shop by check. Paid rent of shop by check on the same day. Paid rent of shop by check. So March 2nd. Rent account. So March 2nd. By check means bank account. What is the amount? The amount is 1,000. 1,000. So the entry is complete. So now come to the next. Sold goods to Barney on credit. Sold goods to Barney on credit. So sold goods to Barney on credit. Okay, so just बाद में हम पे बाद में what date? So it's on 3rd March. On 3rd March. 3rd, 3rd March. So you know why it is debited, why it is credited, right? So this all these aspects are clearly explained in chapter 1 and chapter 2. So if you have any doubts, you can just revert back to chapter 1 and 2 to see which accounts will be debited and why and all these things, so that the concept is clear. So don't assume, presume without with half knowledge. Don't try to do the problem. So be sure, 100% sure before passing the entries. So don't commit any mistakes, so that the concepts are clear. So if the concepts are not clear now, then everything will go wrong. So the amount is 2000. So everything will go wrong. So be careful. Then, so the entry is complete. Sales entry is also complete. Made cash sales of goods. The money was used to set up cash cash flow. So you are receiving cash on selling of goods, cash sales. So cash sales are happening. So sales are always sales, whether they are cash sales or credit sales, or if you want, you can write it separately, credit sales and cash sales separately. So this, since this is a simple problem, it's okay. You can write both merged together. So cash you are receiving. How much you are receiving cash? It is 550 bucks. So 550 you are receiving cash. So when is it? It is on 3rd March. 3rd March. So March 3rd. So cash. So or otherwise you can write sales also. It's not an issue. It is not wrong to write sales. And in cash column you write. So what is the meaning of cash note? To keep it handy. To keep it handy. Cash to keep it handy. They have sold some goods and they have kept money. So sales the same date, cash account 550. Okay, now coming to the next part. Returned faulty goods to Joe. Returned faulty goods to Joe means from Joe we had purchased, now we are returning. So it is purchase returns 200. Fifth. On fifth there is purchase returns. On fifth there is purchase returns to Joe. How much? 200. 200. Don't forget to mention the currency. So to whom we have written? Joe we have written. Where is Joe's account? Joe's account is here. So, March 5th. What is the value? 200. 200. 200. 200. So the entry is complete. So now come to paid Joe by check the goods we had bought after deducting 5% cash discount. So cash discount. So we have to calculate how much you are paying. So 4,000. 4,000 is the purchase and 200 is the return. So 3,800. 3,800 we have to pay 5% cash discount. You have to deduct and pay 3,800 minus 5%. 3,800 minus 5%. You have to deduct and pay. $190 is the discount. 190 is the discount. 190 is the discount. So you are paying Joe. Joe discount. So 190 is the discount. So how much you are paying? 3610. 3610 you are paying. So when you are paying this, you are paying this on 7th. So you are paying this on 7th. 7th. So you are paying this on March 7th. What is the amount of rent you have paid? Rent you have paid 1,000. Okay. Rent you have paid 1,000 and you have paid it by check. So, okay. So this is also done. Now cash discount over. Paid for postage by cash 20. Paid for postage by cash 20. So paid for postage by cash what date? 7th itself. Postage. Postage account by cash 20. So postage account you have to enter in postage account also. No? So you have to enter in postage account also. Cash 27th March. March 7th. So dollar Joe you have paid, right? Where is the entry related to Joe's payment? You have paid to Joe. How much you have paid to Joe? We have received cash discount received also. Discount received and you have paid money to bank account. So bank account is 3610. $190 is the discount received. So discount received also should be entered. Discount received is again. So Joe has Joe account. So 190. So the entries are over. So all the entries have been made. So please cross check whether all the entries have been done. So you can cross check, I am sure, but you also cross check. Then now prepare the necessary ledger accounts and 3-column cash book. So we have prepared 3-column cash book. Balance the accounts at 7th March and bring down the balance. Now we have to balance and bring down the balance. Now this part is remaining. So we have to learn how to balance the account. So this we are going to learn. This is the main thing we will be learning in this lesson. So come to cash book. So cash book, what we have to do, has everything been entered in cash book? Cross check once if everything has been entered. So then what you have to do, you total it up. So you total it up like this. So when you total it up, obviously okay. So you see, in the cash column there is a total of 550 on the debit side. Bank column there is a total of 10,000 on the debit side. Discount column there is nil. Here discount column there is 190. Cash column 20 is in credit side. Bank column there is 4610. So how we have to balance is, which side is heavier, this side is heavier, this side is heavier. So this minus this side minus this minus this. So basically balance carry down your pressure. The balance carry down your right. Then what you have to do? You have to find the difference of this value and this value. You have to find the difference of this value and this value. So whatever comes, that you have to write. So is equal to 10,000 minus 4610. So 5390. See, when you put this value, this both will become equal. So the total should be such that whatever amount you put, the total will be same. See, this should be same. So to find that, we have to put that balancing figure. This is the balancing figure. That's why it's called balance carried down. So we want to balance it. Similarly, here it is 550. Here it is 20. So what you have to do here also, 550 minus 20, 530. So that even this, both the total becomes 550. And what about discount column? No, never. Discount column should never be balanced because it is just it is not part of double entry. We are just posting it. So we should not. We should have to write this directly to the ledger account. So it is discount received. We have to write as it is. We should never balance this. Remember, we should never balance discount column. Never balance discount column. If you balance discount column, it's wrong. So when you are doing cash book problems in AS level and IGCSE, you may be asked one or two cash book problems. So never balance the discount column. Should never balance the discount column. Then here, capital account should be balanced. So now I'm coming to here. This is cash book is over. Cash book is done. So this is known as both book of prime entry and book of secondary entry also. It is ledger also because cash, it is cash ledger and bank ledger. So it is cash ledger, bank ledger. So that's why we never record, we never prepare ledger account for cash and bank. This is both. So it is both primary and secondary book. So now we have left out with the other accounts. What are the other accounts? Capital account. So capital account, this side is 10,000. So this will become balance carried down 10,000. So that both the sides are equal. So this is how did you get this? This is 10,000 minus 0 because nothing was there on the debit side. So the same value will come. So here the amount is same. So this will become balance carried down will become balance got down. When is this? This is March 7. So total 10,000. 10,000. So balance brought down will be again 10,000. Balance brought down. Okay. So normally nominal accounts like purchase account and sales account, they are not balanced. Why they are not balanced? They are directly taken into trial balance. They are just totaled and taken into trial balance. So rent account is not balanced. So you have to just total it up and take it directly to trial balance. So Joe's account. So if you see, both the sides are matched. So both the sides are same. So there is no question of balancing at all. So both they are already balanced. There is no balance brought down or carried down. So there is no difference. So that's why you should not do anything. Then rent account is a nominal account, expense account. So it is not balanced. So just we have to total and take it to the trial balance directly. Barney account. Barney is a customer. So accounts receivable. So we have to balance it. So it should be balanced on March 7. It should be written as balance carried down. So that will be same amount 2000. So again the total is same 2000. Total should be same on both the sides. Remember, both the sides total should be same. So these are the totals. So what happens is 8th March, March 8th, they become opening balances. March 8th, they become opening balances. They become balance brought down. We have to bring down the balance. So that is 2000. So posted account is not balanced. It is a nominal account directly transferred to this one trial balance. Sales account directly taken into sales account directly to trial balance. There is no question of balancing. Purchase returns you should not do. So you should just directly take it to the thing trial balance. So discount received Joe account directly taken to trial balance. So what should be balanced is only the personal and real accounts and assets and liabilities. That's all. Always assets and liabilities should be balanced. So whether they are non-current assets, non-current liabilities, only they should be balanced. In other words, the balance sheet items. So they are called the items of balance sheet. So these are assets. No, cash is an asset, bank is an asset. So it is something which we always keep. So it will always be running. So that is why. So see here, balance carried down will become balance brought down in the next year. So it was balanced on 31st March. On 7th March, the balance was 530 rupees. $530 and $5,390. So which became opening balance on 8th March, that is $530 and $5,390. So this is how we have to balance. So this is done. Goodbye. Have a good day. Hello, dear friends. This is one simple lesson with the classification of accounts and division of the ledger. So we have seen in part one, we have read everything about it. So this is a simple practice exercise just to question up. So we can just discuss this. Complete the following table to indicate whether or not the following statement is correct. The purchase of motor car is revenue expenditure. It's false. It's not true because it is capital expenditure. It's false. So then the payment of wages to employees is revenue expenditure. True. The account of customer is kept in sales ledger. The accounts for customers are kept in sales ledger. No, no, no. It's false. The repairs of the office windows is an example of capital expenditure. False. It's revenue expenditure. It's not capital expenditure. The purchase of office stationery is revenue expenditure. True. The sales account is a nominal account. True. The figure and fittings account is a real account. Fixtures and fittings account is a real account. True. Suppliers accounts are kept in nominal ledger. False. They are not kept in nominal ledger. They are kept in specific suppliers accounts, payables ledger. The day-to-day cost of running the business are an example of revenue. Yes. True. Revenue expenditure. So complete the following sentences by inserting the correct word from the following list. The sales account records the dash of the business and example of dash account. Complete the following sentences by inserting the correct word from the following list. The sales account records the revenue is an example of nominal account. Revenue Nominal account. The purchase of new machine is an example of capital expenditure. Non-current. Non-current expenditure, and the account is an example of real account. Small items and expenses expenditure recorded in petty cash. A dash asset is required to keep the business for a long period of time. Non-current asset again. So here it's not non-current. It's capital expenditure. Capital expenditure. Okay. Very simple problem. So we'll wind it up and we'll continue in the next class. Dear friends, welcome to Shasha's virtual classroom. So today we'll be discussing trial balance. How to prepare a trial balance, and so here you can see there is a practice exercise. This is from David Hopkins. So you can see they are given all these things, all the details, sales, returns, purchases, and all they are given. And prepare a trial balance as at 31st December 2015 from the balance extracted from Hopkins books and calculate the balance on his capital account. So we are supposed to prepare the trial balance. So how do you prepare the trial balance? So the trial balance, the format of trial balance is something like this. So trial balance as on 31st December 2025, particulars, debit, credit. So it is a statement, okay? So it is a statement. That's why it is trial balance as on 31st December 2015. So we have to just plug in the figures. So they would have given the details. We have to just plug in the figures. What will come in debit and what will come in credit? Sales will always come in credit. Sales return is opposite of sales. Sales return will always come in debit. Purchases always debit. Purchase return always credit. So you have to understand this. Whatever you have learned till now, you have to apply, and then you have to prepare the trial balance. So coming to the question again here, see the question is here. So remember one thing, before preparing trial balance, just remember one thing, assets and expenses are all debit balance. Okay, assets, real account assets means uh, plant and machinery, delivery van, bank. So all these are assets. So all these and expenses. So purchases, wages, eating and lighting, all these are expenses. Are all debit balance. They should be all be debits. So this will always be debit balances and they should appear on the debit side. Okay. So remember this, learn this by heart. So this is very much helpful. Very basic foundation to for balancing. Then liabilities and income. Liabilities and revenue are all credit balancing. Liabilities and revenues are all credit balances. So what are liabilities? Liabilities are something we owe, right? So liabilities can be internal as well as external. So internal is capital. So external are like loans, accounts payable, all those are liabilities. So payables, all payables are liabilities. So these are all external liabilities, these are internal liabilities. Whether they are internal or external, they are always credit balances. Revenue or income are all credit balances. They always you have to write on the credit. So simple. So unnecessarily don't exaggerate, learn a lot of things, nonsense and everything. Just remember this. You can do. You have to just identify whether the given particular item is debit or credit. So sales is a revenue. So it is an income, it is a credit balance. So sales return is a debit balance. So purchases is a debit balance. Purchase returns, purchase return is again credit balance. Wages is again debit balance. Heating and lighting expense debit balance. Rent payable expense debit balance. Rent receivable income revenue credit balance. Advertising expense debit balance. Postage and telephone expense debit balance. Discount allowed expense debit balance. Discount received income revenue credit balance. Plant and machinery asset debit balance. Delivery van asset debit balance. Bank balance asset debit balance. Trade receivables asset debit balance. Trade payables liability credit balance. Drawings opposite of capital, that is always debit balance. Drawings by default credit balance, but it is balancing figure. So you have to put accordingly. You just put it on the debit side or credit side, and then you can you total it up, you'll get the value. So we'll just do it. So we can prepare the trial balance. So seeing the question. So here you can see this is the question which is available. So you can make down, note down, or take a screenshot or whatever. Or if you have the textbook, you can use it. Or take the screenshot and then we will just finish that. So now sales. Sales is an income. Sales return is an expense. Purchases is an expense. Purchase return is a reverse of purchases. Wages is an expense. Heating and lighting is an expense. Rent payable is an expense. Rent receivable is an income. So it should come on credit side. We'll rectify it. Or advertising is an expense. Post and telephone is an expense. Discount allowed is an expense. Discount received. So see rent receivable. So rent receivable is an income. So discount received is an income. Plant and machinery is an expense. Is an asset. So always a debit balance. So then delivery van is an asset. Always a debit balance. Bank is an asset. Debit balance. Trade receivables is an asset. Debit balance. Trade payables is a liability. Drawings always a debit balance. So then so when we total it, we get these values 210,000 and 175,000. So capital will be the balancing figure. So what you can do is 2 lakh 10,000, 210,000 minus 174,000. So see, when you put this, this will both tally. So this is balancing here symbol. So it's very simple. Just you need to know this concept. So just remember, all assets and expenses are all debit balances, all liabilities and revenues are all credit balances. Just remember this simple funda. It's very simple, very easy. So easy marks if it comes into question, and any question based on this either MCQs or anything, it's easy mark. So don't miss out. So lot of questions are based on this balances, concept of balances. We'll be often using this technique in solving lot of problems. So be prepared. So we'll just finish this, and we'll just see the next problem. So next problem is, an inexperienced bookkeeper has extracted the trial balance as at 31st December from RT's books. It contains some errors and does not balance. Premises, this is correct. Our plant and equipment, this is correct. Office equipment, asset, correct. Wages is correct. Rent payable is an expense, so it should not come here. So it should not come here. It should come here. So heat and lighting correct. Other operating expenses correct. Sales is correct. Purchases is correct. Discount allowed is an expense. It should come here, not here. So discount received is an income. It should not come here. It should come here. Bank account is a debit balance, correct. Trade receivables is a debit balance, correct. Trade payables is a liability, it's correct. So purchase returns. Purchase returns are opposite of purchases. It should come on the credit side. So it should not come here. It should come this side. So sales return. Sales returns are reverse of sales. They should be debit balance. It should come here. Rent receivable is an income. It should come this side. Capital is a liability. Drawings should not come here. Drawing should come here. So that's all. So you can do this as a assignment. So it's very simple, very easy. So this chapter is done, and this is the end of bookkeeping. So we'll see. We'll start financial accounting in the next class. Till then, bye bye.
Books of crime entry. This lesson we learn everything about what are the books of crime entry, the specific process of maintaining each of these books, the pattern in each case, how to record discounts, trade receipt, the rule here, correct of crime, completing the entries and posting. All together we discuss and practice questions based on this. Books of crime entry. Book of crime entry is used to list all transactions of the business because they are posted to ledger accounts. They are sometimes known as books of crime entry or output. Books of crime. Sales journal or sales return, purchase return, cash
cash book. The cash book is the book of prime entry for all cash and bank transactions. We have a cash account and a bank account. When we use a cash book, two accounts no longer appear in the ledger that replace the cash book. This means the cash book is the only book of prime entry that is also part of the account. The cash book has both a debit side and credit side. The cash book is also used as a book of prime entry for cash discounts. A column is provided on the debit side to record discounts allowed and a column on the credit side to record discounts received. How to enter discounts in the cash book? We take the receipt from the customer or the cash discount. We enter the amount of the discount in the discounts allowed column and to the amount received in the bank column. Similarly, enter discounts received from suppliers in the discounts received column and to the amount owed to the bank column. How to post discount? The total of the discounts allowed column in the calculator is posted to the limit of discounts allowed account. The total of discounts received column is posted to the limit of discounts received. This now means that the double entry to record the discounts allowed and received is the discount columns in the cash book are not part of the double entry column. They simply mean the discounts allowed and received. Three-column cash book. Most businesses receive cash discount and the place of an account for this is kept in the cash. It is usually found convenient to have columns for cash next to those for the account for cash. The account is then a combined cash and bank. Format of three-column cash. So this is the format of three-column cash. One is the debit side and one is the credit side. This has date, particulars, folio, discount, cash, bank on both the sides. The left side is to record the receipts and the right side is to record the payments. Contra entry. The cash columns are entered in exactly the same as bank columns. Cash received is entered in cash must be credited in the cash column. When cash is bank, the cash column must be credited and bank column must be credited. When cash is drawn from the bank column must be credited and the bank column must be credited. This type of posting is known as contra entry. As an account has been credited, bank or cash and another credited cash or bank, the double entry has been completed. There is no need to make any other postings in the ledger to record this. The journal. All transactions will be recorded in accounts of the entry before being posted to the ledger. The journal or transactions for this to record the book of the ledger. Each journal entry shows the account to be debited and the account to be credited. Items which will require entries in the journal: correction of certain errors, adjustment of accounts, transfer to the account, purchase and sale of items other than opening entries. Format of journal or general journal. So it has 5 columns: date, the date of the entries, particular, which says which account is debited and which account is credited, folio, ledger and page number. So debit amount to be debited, credit amount to be credited. A description why the transaction was necessary, then debit and credit, DR and C. DR is short for debit and CR is short for credit. All the journal contains about debit and credit. The journal is not part of the debit. It is simply a book of instructions telling the bookkeeper which account is debit and credit. Narrative journal. Every entry in the journal should have been more brief but informative for the account analysis. The journal is an important validation data that proceeds to the account. Before that process, the owner of the business should authorize the account. Does the person preparing journal write the narrative to the owner why the entry is being made? It is another form of checking which should do in any good accounting system. So, dear friends, welcome to Shosha Virtual Classroom. So, we'll be doing exam practice questions. This is again from David Hopkins. Similar questions are being asked in base level examinations. So, this is from statement of financial position. Okay, so statement of financial position. multiple choice question. The purchase of an office computer has been debited to office expenses. So where should that be debited? Office should be debited to non-current asset, right? Because it is office computer, so it is non-current asset. So we should go to non-current asset. Whereas they have debited to office expenses. So what has happened? The profit has come down. So the profit has come down. The profit is understated. The profit is understated. The profit is understated. And even net current assets is also understated because it has not been shown as a part of non-current assets. When you don't show, then the assets will be understated, right? So this is the answer. Simple. Okay. Then next one. So the owner of a business has taken goods for her own use, but no entry has been made in the books to record this. Oh, so it has not been made. So what happens? What row will show the effect of this on the statement of financial position? So what happens? Oh, inventory will be showing higher. Inventory will be showing higher because inventory has not been recorded. Drawings has not been recorded. So it will be showing. It will be overstated. What will be overstated? Inventory will be overstated. So then what happens? And even obviously the double effect. To complete the entry, you would not have debited to capital account. So the capital also will be overstated. So this is the right answer. Okay. So the following information has been extracted from a statement of financial position as of 31st December 2015. Non-current assets are 310,000, working capital is 30,000, long-term loan is 20,000, profit per year is 35,000, drawings is 25,000. So non-current assets, working capital. So what are the steps? You have to add non-current assets and working capital, right? So you have to add the non-current assets and working capital. So that will be 3,40,000, 340,000. So long-term loan you have to subtract because it is non-current liability. Non-current liability you have to subtract. So that should be 320,000. So 320,000 is net assets. So we have done the problem already. So net assets should always be equal to capital. So what is the net assets? Net assets is 3,20,000, 3,20,000. So what was the balance on the capital account on 31st December 2015? So this has no relevance. This has no relevance. So if the concept is clear, you will not even think about these two items. You will just straight away see this and you will select this. So that's why the concepts are very, very important. You have to clearly understand the concept. If you have not understood the concept, then you will get this wrong and will mess up. So don't be in a hurry when solving MCQs. Be careful. Carefully you solve the MCQs. Explore all the options. Be conceptually perfect. Be conceptually strong to secure A plus in A levels. Okay. So don't be in a hurry. Never be in a hurry. So which of the statements is not correct? Assets is equal to liabilities plus capital. Correct, no? Liabilities, assets is equal to liabilities plus capital because assets is equal to liabilities. So capital is also internal, internal liability. So this is correct. Okay. So capital is equal to assets minus liabilities. This is also correct. Just now we did assets minus liabilities is equal to capital. This is also correct. Then capital minus liability. Capital is also liability. This is also liability. They cannot be equal to asset. This is wrong. So this is the correct answer. So liabilities is equal to assets minus capital. Correct. Assets minus capital will always be equal to liabilities. So you can do this using the formula. So by substituting here and there this one. So you know that, right? So assets is equal to liabilities. So you might have already learned this. in basic accounting, like accounting equation. So you might have done a lot of problems also based on this. So if this is the first lesson that is taught in accounting, so you must be knowing this. So when you just crisscross this, when this comes this side, it becomes minus. When minus comes this side, it becomes plus. So all these things, if you know this basic simple math, then you can do this. So simply, so this is the answer. So this over. So we have covered statement of financial position. One simple problem also we have done. We have done MCQs also. So you have understood the concept very clearly. So please share. Please spread the knowledge. Please share so that others also get the benefit of my classes. Okay. So please share. Thank you. Have a good day. Good night. Dear friends, welcome to Shasha's virtual classroom. So today we will be discussing statement of financial position. So we will be, this is very important class. So please have patience and focus on this. It's very important. Okay. So statement of financial position. Financial position. In 5 steps. So first step. First step is non-current assets by default. Okay. So non-current assets. First, you should understand what are non-current assets. So you have to make a list of non-current assets. The trial balance would have been given. So from that you have to make a list of non-current assets. So what are the non-current assets? Non-current assets are those assets which are intended to use in the business for a period of more than 12 months. For a period more than 12 months from the date of financial statement. So very important. Okay. So non-current assets are those assets which are used, which are meant to be used in the business for more than 12 months from the date of financial statements. So what are financial statements? Statement, income statement, statement of financial position, and cash flow statement are known as financial statements. So basically here, what all is included? So you have to include, you have to prepare the list in such a way that most permanent ones are written down first. For example, land and building. Land and building. How many years do you use land and building? Maybe forever. So land you will never intend to sell. Normally you will never intend to sell. And building maybe you may again you may change it after maybe 15 years or 20 years or maybe after 25 years or 30 years or something like that. But land will never be. It's not in the bit. So it is more permanent. It is most permanent. Then what is the next one? Next one is machinery. Okay, so plant and machinery. So plant and machinery, maybe you can use it for at least 10 to 15 years unless there is any technical changes. So the next one. So then comes vehicles, motor vehicles or vehicles. So because you'll be using them for a longer period. Then comes furniture. So non-current assets, they are those assets which are intended to be used in the business for more than 12 months from the date of financial statement, and they should be written down in the order of permanency. So first land and building, then plant and machinery, vehicles. So based on whatever the items the business has, based on that you have to use your common sense and you have to prepare the list. So that is the first step. You have to prepare, you have to write down the list of non-current assets. Then second one is current assets. So what are current assets? Current assets are those assets which may vary. So immediately after 12 months, if they say the very next day, they may change. So they are inventories. So what are inventories? Inventories are merchandise which are lying in the business after the on the date of preparing the financial statement. So inventory. So that is one thing. Then trade receivables. So what is trade receivables? Trade receivables are credit customers. Credit customers from whom we have to receive money. So to whom we have sold on credit and we are supposed to receive money. And the third one is cash and cash equivalents. Cash and cash equivalents. What are cash and cash equivalents? Cash and cash equivalents means it can be cash in hand, cash at bank. So maybe those fixed deposits which are immediately which can be immediately materialized, like very short-term cash deposits. So all those are cash and cash equivalents, particularly cash and bank balances. So we have this order is important. So it is recommended that the order of these assets should be in this particular order. So again, the items are based on the question. So whatever details have been given in the question, based on the items that have been given in the question, so the current assets list of current assets should be prepared. Then third one. Then third one is current liabilities. So remember, this is with regard to financial statement of sole traders. Okay, these are with regard to a financial statement of sole traders. Because when you are preparing financial statements of company, the format is entirely different. The format is entirely different. The items are same, but the headings are same, but they have to be shown that the form of presentation is entirely different in case of companies and other entities. So be careful. So this is meant only for sole traders and you have to learn this. You have to learn this how to go ahead with this preparation of statement of financial position, current liabilities. So what are current liabilities? What are current assets? Current assets are those which change within a period of 12 months. Inventories today, inventories may be something else. Tomorrow there may be something else. You keep buying and selling the goods. So similarly, trade receivables. So you keep selling, you keep receiving the money, so they will not be same. Cash also, cash will be receiving and paying. So that's why this will not be same. So because of this, all these are, what do you say? They are dynamic in nature. They are dynamic in nature, means they keep changing. So this is another way you can remember. You can just use your common sense to identify and make a list of current assets. What are current liabilities? Current liabilities are, see, trade payables. Okay, so what are trade payables? So credit suppliers. So you have purchased goods on credit, you have to pay them after some time. So maybe after 30 days, after 35 days, 40 days, 45, whatever. So you have to pay immediately. It is payable within a period of 12 months. So this also within 12 months. Okay, so trade payables. So again, what is the bank overdraft may be there? What is bank overdraft? You might have made arrangement with the banker to take money for a shorter period. So that is what is bank overdraft. So then what you have to do when you are preparing the financial statement. So remember, first you have to write non-current assets. Non-current assets you have to write. Then you have to write current assets. Then current assets, the figure total. So then this one again, current liabilities total. So what you have to do is you have to find out current assets minus current liabilities. You have to calculate current assets minus current liabilities. So that is called working capital. So what is current assets minus current liabilities? So 2 minus 3. Though you are not required to write what is working capital, you don't have to write this. This is just for you to remember so that you don't mess up when you are working out the answer. So always remember 1, 2, 3, 2 minus 3. So whatever amount comes, you have to write here. Then fourth one. So non-current liabilities. So what are non-current liabilities? Liabilities that are payable more after a period of 12 months from the date of balance sheet. Okay. So more than or after 12 months from the date of balance sheet. For example, bank loan. So bank loan normally when you will pay after a period of maybe you may pay after 2 years, 3 years, or it may be even pay 10 or 15 years also. So that's why it has payable after a period of 12 months. So what is the example, best example for this? Maybe you have taken a bank loan. So maybe you have taken long-term loan for many years. So which has to be repaid after a period of 12 months from the date of statement of financial position. Okay. So then even that you have to add. You have to add this. You have to add all this. So you have to add bank loan, long term loan. So you will get one figure. This item you have to subtract. You have to subtract from this, and this is called net assets. Net assets. What are net assets? All working capital minus working capital. So net assets are nothing but non-current assets plus working capital minus non-current liabilities. What is working capital? Working capital is nothing but current assets minus current liabilities. So very important, don't get confused with, don't confuse yourself. Very important. So first we have to find out non-current assets. To that we have to add working capital. So what is working capital? Current assets minus current liabilities. Current. Okay. Current assets minus current liabilities will give working capital. So from that again you have to subtract non-current liabilities. So that gives net assets. So then the fifth item. The fifth item. What is the fifth item? Fifth item is owner's equity. Fifth item is owner's equity. Okay. So what is owner's equity? Capital at the beginning. Add net profit. So less drawings. So the net amount will be the capital, owner's equity. Okay. So the net amount will be owner's equity, that is the capital. So ultimately, this should be equal to net assets. So finally, net assets is equal to owner's equity. You have to follow these steps particularly in this particular order, specific order. Just follow this. You can do any damn problem in statement of financial position as far as sole traders are concerned. So you will just work out another problem, one simple problem to demonstrate this, how to find out how to prepare statement of financial position. Till then, have a good day, goodbye, good night. Friends, welcome to Shasha's virtual classroom. So today we will be discussing statement of financial position. So what is financial position? Statement of financial position. Statement of financial position shows the assets and liabilities of any business. So it is a statement. Okay, it is a statement. So it is a statement as on. So the rule is you have to mention the trader's name and then you have to mention statement of financial position as it. Okay. So here for income statement we just write for the year or for the period, but here we have to write as at. So whatever date it is, 31st. So month and year. So whichever. So it may be March or this may be 2025. So any year, okay. So statement of financial position as at 31st March or 31st whatever. So and year also whatever. So this is how we have to write the heading. So this is the basic rule, very first rule, and then we have to remember 5 steps. Okay, so remember 5 steps. So the 5 steps are non-current assets, current assets, current liabilities, remember this rule is applicable only for sole traders. Okay, sole traders. The format is different for companies. The format is different for companies. So in case of sole traders, you are supposed to follow this format. Non-current assets, you have to first classify the items of non-current assets. Then you have to classify current assets. Then you have to classify non-current assets. Then you have to classify non-current assets, current assets, current liabilities, non-current liabilities, then so this is first item, second, third, fourth, and fifth. So what is fifth? Fifth is nothing but owner's equity or capital. So remember these 5 steps. So what we are supposed to do? Non-current assets. What will come in non-current assets? Non-current means those assets which never change. So normally they don't change during the course of business. For example, plant and machinery, land and building. So see, if we have plant and machinery, normally we use it for several years. Land and building we will use it for maybe 20, 25 years. So like that. So that's why they are called non-current assets. So what are current assets? Current assets are inventories, accounts receivables, in this one cash and bank balances. So current liabilities. What are current liabilities? Current liabilities are those which are payable. For example, trade payables and bank overdraft. So non-current liabilities. What are non-current liabilities? Non-current liabilities are those liabilities which we are not obliged to pay immediately within a period of 12 months. Like suppose we have taken loan from bank or long-term loans from anyone. Okay, so that is why they are called non-current liabilities. Owner's equity or capital. Owner's equity of capital means the money invested by the owner. So again here we have to start with opening capital, add profit, less drawings. So whatever you get is closing capital. So closing capital we have to show in the ultimately we have to show as a net flow. So these are the 5 steps, 5 items. Okay, so 5 steps or 5 main headings. 5 items, 5 steps, 5 main headings or 5 items, however you remember. So non-current assets. Non-current assets are those assets which are held for more than 12 months. For more than 12 months. Okay. So for more than 12 months. So the current assets they keep changing. So these amounts are receivable maybe immediately within a period of 12 months. So current liabilities, it's less than 12 months. So again, this may be immediately payable. So those things. Non-current liabilities are again more than 12 months. More than 12 months from the date of balance sheet. Okay, more than 12 months from the date of balance sheet. More than 12 months from the date of balance sheet. So non-current liabilities more than 12 months from the date of balance sheet. Owner's equity or capital. This is the thing. Now, how to show how to prepare the income statement. So first we have to start with statement of financial position as it. So you have to write trader's name. So then you have to write statement of financial position as it. So whatever date it is. So then particulars. So what date? So you have to write the specific date. Dear students, dear friends, welcome to Shasha's lecture classroom. Today we will focus on important points in income statement. So they are very important in the sense that most of the students they commit mistakes. Often they think whether we have to how to treat a particular item. So to start with, important considerations in preparing income statement. So income statements are often prepared in vertical form. Since it makes them easier to read, you should study and learn the vertical form carefully until you are quite familiar with it. So there are various forms. There is a horizontal form and there is vertical form. But 99% of the cases you will be doing vertical form. So you will be preparing income statement in vertical form. So it is very essential for you to study and learn the vertical form carefully until you are quite familiar with it, so that you can work out the problems with ease. Do not prepare journal entries for the income statements unless you are specifically asked to do. They might have been shown in the chapter simply to help you understand how entries are made. Okay, so there are so many entries. If you look into the chapter, income statement chapter, you'll find a couple of entries. They are not important. In the essence, they are not important. So you don't have to prepare unless otherwise they are asked for. So you can just know it. So in the examination, unless otherwise they are asking you to pass journal entries, you are not supposed to do. The heading is important. Okay, so the heading, when we start any problem, the first thing, the heading is very important. The fact that is the income statement for the year or month ended. So you have to write it as income statement for the year ended. The statement covers a period of time, so it is necessary to state the period covered. Okay. Goods taken by trader for personal use. Some goods, sometimes the trader may take out some goods for his personal use. So what we have to do, deduct goods taken by the trader for personal use from purchases and add to drawings at cost price. So they would have given selling price also. So you should not get confused. You have to always deduct at cost price. You have to deduct goods taken by the trader for personal use from purchases and add to drawings at cost price. So the adjustments will be reflected two places. Carriage inwards. Carriage inward is taken as part of cost of sales, not an expense. Okay. So carriage inward is what is carriage inward? Carriage inward is the amount spent on getting the goods inside the premises where goods are being traded. So that is why they are called carriage inward. So to bring in the goods inside for the trading purpose. So that's why they should be added with cost of sale. To sell the good, those are the expenses incurred to sell the good. That's why they are added to cost of sale. We should not treat it as an expense, like expense in the sense which we have to show below the line. So it should be considered as part of cost of sales. Carriage outward. The cost of delivering goods to a customer is carriage outwards and is debited in the expense statement as an overhead expense. Okay. So it is debited as an overhead expense. Double check the treatment of carriage inwards and carriage outwards. So carriage inward will be reflected in cost of goods sold and carriage outward will be reflected in overhead expenses. Wages treated at the cost of sales. So goods purchased may not be in a suitable condition for selling to customers. Sometimes what happens, they may buy the goods and they may do some work on it. So further work may be required to them before they are sold. So maybe some rectifications will be there or some final touches will be remaining. Some work is pending. So on that you may spend some money. So the wages paid to employees for performing this work. Which work? The additional work on the goods. Okay, so this work should be debited as part of cost of sale. So that particular part of expenses, the costs which are incurred to improve the product. This should be treated as part of cost of sales. Gross profit. The gross profit is the profit earned on selling goods before any other expenses are taken into account. So, sales minus sales returns will give you net sales or net revenue. So, to that you have to, from that you have to subtract all cost of goods sold. So, what is cost of goods sold? Cost of goods sold is nothing but opening inventory. To that we add purchases less purchase return. So, to that we add carriage inwards, and from that again we subtract the closing inventory. So what we get is cost of goods sold. So what do you have to do? From that, once from net revenue, we have to take out cost of goods sold. Then what we get is profit. So gross profit. So what is gross profit? Gross profit is the profit earned on selling goods. Okay, the profit earned on selling goods before any other expenses are taken into account. When there is no trading account, when there is no trading, there is no gross profit. It's very important. Okay. Some cases you may be asked to prepare a statement, income statement, where they would not give any opening inventory, closing inventory, even the purchases may not be there, sales may not be there. For example, in case of service industry, service people who are rendering services, service business, they may not have any inventory. So then in that case, gross profit, the question of gross profit doesn't arise. The words cost of sales and gross profit are important and should always be shown. Okay, so never miss out. In a hurry, what most of the students they do, they forget to write cost of sales as a heading. They forget to write gross profit. So that should be avoided. So you should be very careful. So you have to write it. So the words cost of sales and gross profit are important and should always be shown. Should means it is mandatory. Always include the words cost of sales and gross profit in full. So avoid using short forms. So you cannot write COS, GP or something like that. So you should not use short forms. You have to use full form. You have to use full words. Include the words, full word. Okay. So you cannot use the shortcuts. Any other income. You should add any other income to gross profit. So suppose you have got other than sales, if you have got any other income, you have to add it to the gross profit. Never treat it as a negative expense. Negative expense means don't deduct it from expense. Never do that. So you should not show it as negative expense in the expenses column. You have to just add it to gross profit. So because that is also income, but it is not from trading, it is other income. So that's why it should be added to gross profit. Overhead expenses. So we have to, after you add up other expenses, there are overhead expenses which you have to show. So there is no particular order in which overhead should be shown in the income statement of sole trader, but it is often best to place the larger amounts before the smaller. So there is no particular order, which is not mandatory that you have to show it in particular order or something like that. But it is often best, it is a best practice to place the larger amount before the smaller, so that you show the bigger amounts first, then you show the smaller amounts. It is also a good plan to group together similar kinds of expenses. For example, property expenses, rent, heating and lighting and insurance. So you can club up the similar type of expenses and you can show. There is no such prohibition that you have to. So, and this is not compulsory. So this is what is it is an option. So it is better if you do it. So the examiner will be impressed. Profit for the year figure. The profit for the year figure is important. You will need to use it when you prepare the next document, the statement of financial position. So profit for the year, you have to show. The profit for the year is important. You have to show. After the end result is profit for the year. You need to use it again when you prepare the next document. So the next, the chapter after this is the statement of financial position. There you will be using the net profit, whatever you calculate. Other chapters where income statements is prepared. See, income statement is very important. So it's very important in the sense, again when you study accruals and prepayment, this is another lesson. So another chapter, the matching concept. So in this also, if we incorporating this, you have to prepare income statement. So again, there is one more chapter, provision for depreciation of non-current asset. Again, there also you have to incorporate the depreciation and you have to prepare income statement. Irrecoverable and doubtful debts. Again, there is another lesson, another chapter called irrecoverable and doubtful debts. There also you have to incorporate these things and you have to prepare income statement. So this is the income statement is the base. So to that you have to make lot of other adjustments. So incomplete records. Even in case of incomplete records, you may be required to prepare income statement. Not for profit organizations. See, not for profit organizations means clubs and societies. So there may be a bar or cafe or something like that. So there they may be doing some sort of business. They may buy some inventory, they may sell something. So all those things. So even there you need to prepare income statement and you have to show it as income. There also you need to. So it is very important lesson. So very important. So but this is the base, and you have to learn all this as a comprehensive. So that is how, that is where a lot of students commit mistake. So you have to be very careful, you have to be very attentive, you learn each and every aspect, learn every lesson carefully, learn every chapter carefully, work out all the problems before attempting the main examination questions. You have to be double sure, you have to be thorough in these particular aspects. Income statement is prepared in different forms. See, there are partnership accounts. There also you have to prepare income statement, but the profit is shared between the partners. So that is one difference. And introduction to the accounts of limited companies. There also you have to prepare income statement, but the format is entirely different. The form is entirely different. Manufacturing accounts, where manufacturing account means there are so many other aspects. There are a lot of details given about manufacturing entity. So there also you have to show a lot of other aspects, and there also you have to prepare income statement. So income statement is overall, in overall it's very important, and lot of questions are asked from income statement. So you have to be, it's very important topic. Okay. Income statement of service business. See, people who sell their services such as accountants, lawyers, dentists only require income statements. So they don't need trading accounts. So that is there is no question of preparing finding out gross profit, because there is no trading. So if the business is a service business, one which does not buy and sell goods, then there will be no cost of sales. Okay, there is no cost of sales. You will need to show the income, which will be the fees received less the expenses, to leave profit for the year. So it's very simple thing. Okay, so keep these points in mind. This is very important. So then in the next lesson we will start with working out the problems. Okay. So dear friends, coming to income statement for sole traders, the following trial balance have been extracted from Hadley books as at 31st December 2015. So this is extract from David Hopkins. The following trial balance has been attracted from Hadley's books as of 31st December 2015. Plant and machinery 25,000, office furniture 6,000, inventory 1st Jan 11,000, trade receivables 4,740, trade payables 1,976, bank 3,327, loan receivable 5,000, sales 72,800, purchases 28,540, sales return 1,600, purchase returns to 144, wages 3,100, rent 4,000, heating and lighting 5,120, advertising 2,400, other operating expenses 2,010, loan interest to the 250, drawings 4,843. Capital 20,000, inventory at 31st December 2015 cost 9,000. Prepare Hadley's income statement for the year ended 31st December 2015. Income statement for the year ended 31st December 2015. So we have to prepare income statement. So based on this information, so it is Hadley's income statement. So for the year ended 31st December 2015. So, particulars. So heading is very important. So we have to write particulars and dollars, and date is also very important. So name of the trader also should come. Have this income statement for the year 31st December 2015. So what are the 5 steps? First we have to record sales and sales return. So sales minus sales return. So first step, sales minus sales return. So what are the sales and what are the sales returns? Sales are 72,800, 1,600. 72,800, 1,600. So it will be 71,200. 71,200. So now less cost of goods sold, cost of sales, cost of sales. So in this, what will be there? So by default, first one is inventory as at first Jan. Inventory as at first Jan. So how much? 11,000. So first Jan 2015, 11,000. Purchases. So how much are purchases? Purchases are 28,540. 540. Then purchase returns are 2144. Two, 144. So what else? That's it. So carriage inward is there? No, carriage inward is not there. So purchases is over, purchase returns is over. So inventory at 31st December is 9,000. Inventory at 31st December. So even that we have to subtract. So if we add this, so it will be 11,000 plus 28,540 minus 2144, 37,396. 37,396. So minus inventory as at inventory at 31st December 2015. So 9,000. So 37,396 minus 9,000, 28,396. 28,396. So this minus this will give you gross profit. So what is the gross profit? Minus 42,804. 42,804. So this is the gross profit. So to this, we have to add other income. So let us see if there is any other income is there. So okay, so there is no other income. So other income will not come. So if you want, you can just write and leave it blank. Add other income. So when you are learning, you can just write so that you don't forget in the exams. So you miss out and again you have to scratch and again you have to do. That will be a lot of waste of power. So that's why it's better you make a practice of writing this and you write it as zero because there is no other income. So now less overhead expenses. So what are the overhead expenses? So let us see. Wages, rent, heating and lighting, advertising. Wages, rent, heating, lighting, advertising. Wages, rent, heating, and lighting, advertising. Wages, rent, heating, and lighting. So our wages is 3100, 4000, 3100, 4000, 3100, 4000, 4000, 5120, 2400, 2400. Other operating expenses 2010, 2010. Loan interest 50. So total it up 5100 plus 4000 plus 5120 plus 2400 plus 2010 plus 50 will be equal to 16,880. 16,008. So these are all overhead expenses. So minus 42,804. 42,804. So 25,924. 25,924. So what is this? This is nothing but profit for the okay. So this is how you do. So very simple. This was very simple question, very simple topic. But going forward, you will have a lot of adjustments. You have to. The problems will not be simple. But if you remember the steps, you can just uh, increase the learning speed. So incremental learning. So you can learn, add more concepts into that. So prepare at least income statement for there. Keep your answer. It will be needed again in chapter 8. So the answer you need. So answer whatever you have got is required because next lesson is statement of financial position. So in statement of financial position, we need to add the profit whatever we have got. So profit whatever we have got, we need to add. So that's why that's very much important. So in the balance sheet, we have to reflect that. So that's why it is folded. So next let us see. This is finished. We have completed one question. So let us see the second question. So the trial balance extracted from Piccolo's books at 31st March 2016 is as follows. Sales 4,000, sales returns 3,600, purchases 1,20,000, 120,000, purchase returns 4,400, purchase returns 4,400, inventory 18,000, carriage inwards 5,000, carriage outwards 3,724, discount received, this is other income 3,060, discount allowed 5,020, wages 36,800, rent 8,000, heating and lighting 6,450, other operating expenses 1,143, fixture and fittings 9,000, office furniture 2,000, trade receivables 1,920, trade tables 2,130, bank balance 24,920, 2,496, drawings 20,427, capital 30,000. So during that, Tekala had taken goods costing 2,000 for his own use. So this will come as a deduction from cost of goods sold. This had not been recorded in the books of in the books. Inventory at 31st December 2016 cost 20,000. Prepare Ticola's income statement for the year ended 31st March 2016. Keep your answer. It will be I needed again in chapter 8. So hopefully I think you can do this problem on your own. So if possible, take the screenshot of this question. Take the screenshot of this question and put efforts. Try to do it on your own. And if you don't get this, please let me know in the comment. I will do it. We will do it in the class. So otherwise, it will be assumed that you have understood. Then you have got you have completed. So then we'll proceed to the next part. So I will give some time. Just take a screenshot of this question. So next class we'll do exam practice questions. So please let me know if you have any doubt in this question as a comment. So we'll have separate class or I will just explain to you whatever doubts you have. So till then, bye bye, have a good day, good night. So dear friends, welcome back. Welcome back to Shasha's virtual classroom. So today we will discuss exam practice questions from income statement. So this is income statement. These are the questions from income statement. So we will discuss similar questions might have come or expected to come in AS level question papers. So let's discuss this question paper. So what you can do is you can take the screenshot of this, take a picture or try to answer yourself. So then we can continue and just check whether everything has been done correctly or not. So which of the following does not appear in an income statement? So which does not appear? Carriage outwards expense will appear, carriage allowed, discount allowed will appear, discount received will appear. So motor vehicles will not appear. So motor vehicles is an asset. So this will not appear. So the following information has been extracted from the trial balance of business. Sales 1 lakh, purchases sales 100,000, purchases 60,000, wages 21,000. Closing inventory was 3,000, more than opening inventory. Okay. Closing inventory was 3,000 more than opening inventory. So one third of the wages was charged to cost of sales. One third of this, 21,000 into one third is nothing but 3 7 27,000. So cost of sales in the trading section of income statement. What was the gross profit? So they are given sales. So let us do sales 100,000 less. So this is just working. So we can do here. We don't have to follow the rules like cost of sales or this and all. So this is just to calculate. So if you want, you can just write cost of sales. So opening inventory minus closing inventory is 3,000. It is more, right? So first is opening inventory. So we don't know. So we'll keep it in pending. So purchases 60,000. Purchases 60,000. Wages 7,000 to go in trading account. So that is cost of sale. So wages 7,000. So then what to do here? Opening stock is not given, closing stock is not given, but difference is given. So if you recollect, opening stock, opening inventory will be added, and closing inventory will be subtracted. So since the closing inventory is more, so we have to subtract the closing inventory. So closing inventory, so 3,000. So please don't get confused. If the concept is not clear, so just know this: cost of sales is nothing but opening inventory, purchases less purchase returns less wages minus closing inventory. Okay, so purchases is given, purchase returns are not there. So wages is given. So then opening inventory they are not given. Closing inventory was 3,000 more. So that's why we are subtracting. Okay, so very simple. So since we have to subtract, since it is more, so this is positive, this is negative. So play up plus minus. So whichever is greater, this is greater. So that's why we are taking 3,000. So it is 67,000 minus 3,000 is 64,000. 64,000 is cost of sale. So therefore the gross profit will be 36,000. Okay. So next. The carriage inwards of business amounted to 6,000 and the carriage outward was 7,000. The carriage outward was charged in trading account. So this is a mistake. So it cannot come in trading account. It not come in trading account of the income statement in error, and the carriage outward was debited in the income statement. Carriage inward was debited in the income statement. Okay. So what is carriage inward? Carriage inward is 6,000. Carriage outward is 7,000. The carriage inward was charged to trading section in the income statement, and the error. So what has happened? Cost of sales. Dear friends, the third one. The carriage inward of a business amounted to $6,000 and the carriage outward was 7,000. The carriage outward was charged in trading section of the income statement in another, and then carriage inwards was debited in the income statement. What has been the effect of these errors? So the carriage inwards. Okay, see here. The carriage inward 6,000. Carriage outward is 7,000. So what is the rule? The rule is carriage inward should be considered as part of trading section. So that is part of cost of sales. But here what has happened? The carriage outward was charged in trading section. They should not come. Carriage outward was charged in trading section. So carriage outward was how much? Carriage outward is 7,000. So this is 1,000 more. So what has happened? So if this is 1,000 more, then gross profit will be understated or overstated. So I want you to be clear in this. So see whether it is carriage inward or outward, there won't be any effect. So for the profit for the year, there won't be any effect. So this is correct and this is correct. But we have to see among this which one is correct. So don't try to answer the question with a trial and error method. So try to understand the question. So work out. Take some minutes. So it's small time, a bit of time. So just to understand this one. So third one. So let's assume sales. Let's assume revenue as 90,000. Let's assume this is just assumption, okay? So less cost of sales. So assume purchases as 40,000. So now what you have to do? Carriage inward is 6,000. Okay, carriage inward is 6,000. So So this is the actual treatment. So what should be the profit? So 90 minus 46 is, so 90 minus 40 is 50, 50 minus 6 is 44, 44,000. The gross profit should be 44,000 if the actual treatment is done. Now, this is the correct one. The correct. So now the wrong. So what has happened? So revenue is 90,000 itself. Cost of sales purchases is also 40,000. What they have done? Carriage inward. Instead of taking carriage inward, they have taken carriage outward. Carriage outward they have taken into 7,000. So what has happened? So this is carriage outward. So 90 minus 40 is 50, 50 minus 7 is 43. The gross profit is showing more or less because of the wrong error. Gross profit is showing less because of the wrong treatment. The gross profit is understated. Gross profit is understated by 1,000. See, this is how you have to confirm yourself. See what happens, most of the students, because of hurry in the examination, they hurry and because of this they commit mistakes. So they try to answer it in a trial and error way and easily they will lose marks. So never do that. So Hardly it will take 1 minute to confirm yourself. So it is understated. So the correct answer is understated by 1000. So now we are double sure. So we have checked the figures and we are double sure. So this is the answer for this. So this is how we have to do this type of problems when there is a bit of confusion. So you have to confirm yourself whatever you are doing is right or wrong. So next one. So what I suggest you is always when you are doing the MCQs and whenever exercises are given, always you have to try solving on your own. Just see the question, try stop the class. I mean stop the video, pause the video. Just try to work out the answer on your own, and then you compare with the actual solution, so that you are then only the learning will be more effective. Otherwise, the learning will not be effective, and ultimate result will not. You will not get the ultimate result. Okay, so never do that. So please follow my instructions so that the purpose should be served. Don't waste time unnecessarily by trial and error methods and all. Okay. So now come to the next one. So let us see this one. Discount received amount to 10,500. Okay, discount received 10,500. Discount allowed 13,000. So the discount received has been debited. Discount received have been debited. So what we have to do? Discount received should be credited, right? But they have been debited. Okay. And the discounts allowed have been credited. Discounts allowed should be debited because it's in loss, it's an expense. So it should be debited. So this is wrong. This treatment is wrong. This treatment is wrong. Okay, in the income statement, what has been the effect of errors on the profit for the year? So was understated, overstated, understated, overstated. So don't try to answer this the hinky panky way. So let us see. Let us assume and we will do the problem. So then the concept will be clear. So fourth one. So fourth one. So profit before discount. Okay. This is the correct profit before discount. So let's assume it is 40,000. 40,000, 40,000 in both the cases. Then we'll do the actual treatment. Okay. So we'll do the actual treatment. So we'll deduct discount allowed. Because discount allowed should be deducted right from the profit because it is an expense. So it should deduct. So what is discount allowed? Discount allowed is 13,000. Discount allowed is 13,000. So what we have to do with the discount received? Discount received we have to add because it is an income. Discount received we have to add because it is an income. What is the discount received? The discount received is 10,500. So this should be subtracted and this should be added. So what will be the net profit? So what should be the net profit? 37,500. See, this is just assumption. Okay, so we are assuming that this is the profit before discount. So this type of problems we have to do this way so that the understanding is clear, so that we are sure what has happened and what is the effect, net effect. Otherwise, don't try to do some wrong methods, wrong calculations, and try to ultimately. So whatever method you do, ultimately you have to get the correct answer. So that is what it is. So what has been done? They have actually this is the right one. So this is the right one, and this is the wrong one. So what has happened? Wrong one. What they have done? They have deducted 10,500 and they have added 13,000. So then what will be the profit in this case? So because of the wrong profit, 40,000 minus 10,500 plus 13,000. The profit will be 42,500. 42,500. So it is more. The profit is more. Okay. So it is overstated. It is overstated. Overstated by how much? 42,500 minus 37,500 is 5,000. It is overstated by 5,000. See the concept. You are double sure now. It is double sure. It is certain. There is no hinky panky. Like no, you are not trying to guess and write the answer. Never do that. Never do that. Okay. So never do that. So the answer is overstated by 5,000. Overstated by 5,000. Okay, so this is how you have to do. What a lot of the students they do because of hurry, because of the exam stress, they will just try to guess and they will ultimately put either of this one and ultimately they will lose marks. What is the purpose? The entire year you have put efforts and because of some small mistake you will lose marks. So please don't do that. So please be careful. So please learn the ways and methods how to actually get the answer. Now, carriage inwards in a trial balance is to 2300. Carriage inward in a trial balance is 2300. It has been entered in trading section of the income statement. Again, trading section as 3200. In addition, motor expenses of 600 has been posted to the motor vans account. What effect has this on the income statement? So again, we'll not just do it, we'll not just try to do blindly, we'll just try to analyze by understanding the question carefully. So we'll just do it again here. So again, income statement. So let's assume profit before these treatments is again 90,000. This is right. This is wrong. Okay. So what has been done? Carriage inward in a trial balance is 2300. Carriage inward is 2300. Okay. But it has entered in trading section of income statement as 3200. Wrong treatment. What we have done? We have taken it as 3200. Okay. Then next one. Motor expenses of 600 has been posted to the motor vans account. So motor expenses. Motor expense is a expense. So it should go to reduce the profit. So motor expenses. Motor expenses 600. But what they have done? Motor expenses. Motor expenses have been posted to the motor vans account. It has gone to motor vans account means it has not been shown in income statement. So it has not been shown in income statement. So now let us see. So what is the right thing? After you should do the right one. So it will be 90,000 minus 2900. 2900. 87,100. 87,100. So 90,000 minus 3,200. 86,800. 86,800. So the profit is understated. So what has happened? The profit is understated. It is understated. It is less, no? So it should be more. The profit should be more. But the profit is less. the profit is understated. So what is the profit? It is understated. Understated by how much? 87,100 minus this one is 300. Understated by 300. Understated by carriage in which has been entered into understated by 900. Gross profit, okay. So the profit, okay. So this one, this is overstated by 300 or understated by 300. Understated by 300. And even gross profit also will be understated by 900. See, gross profit is also understated by here. Gross profit is okay. So we need to find even gross profit also. So my mistake. So we'll just do it again once again. So please bear with me. So again profit 90,000. So 90,000. So this is just to find out the gross profit. Okay. So less carriage inward is 2300. 2300, and this has been shown as 3200. So this is just to find gross profit. Okay. So what is the profit? Let us see. So 90,000 minus 2300 is 87,700. So then 90,000 minus 3200, 86,800. So gross profit. So actually gross profit should be more. Here it is showing less. So it is understated again. Understated. Understated by how much? Minus 87, 700, 900. Understated by 900. So this one is correct. Understated by 900. This one is correct. This one is correct. So please be double sure. So don't try to guess. Don't try to do the problem without understanding. Never do that. Okay, please never do any problem without understanding. Have a clear-cut understanding of the concept, and please do it so that each and every mark is very, very important. So please do it. Use my classes very carefully. So please share and subscribe. Let others also grow. So let others also get help from this. So be generous. So we'll catch up in the next class. Basically, I will be starting the next one, that is statement of financial position, in the next class. Till then, have a good day, good night, goodbye. Today we will start a fresh lesson, income statements. So what do you mean by income statement? Income statement shows what is the amount of profit for the year. So after preparing trial balance, you may be asked to prepare income statements where you have to show how and how much is the profit for the year. So there may be sole traders, partnership firms, and companies. companies. All these businesses, whether they are sole traders or partnership firms or companies, they have to prepare income statement. So, in AS level, we will be learning income statements of sole traders, partnership firms, and companies. All these three will be learned. So, to start with, we will start with income statements of sole traders. So again, sole traders, there are two types of sole traders. One type is who is involved in trading. The other one is who is involved in services. So trading means what? Trading means buying and selling buying and selling of merchandise to make a profit. So buying any particular goods, any retailer, wholesaler. So that is what is trading. And services are like engineer, doctor, teacher. So all those people are they render services. They don't involve in anything like buying and selling of goods. So trading and services. So now to begin with, we will start with income statement of sole traders in trading activities. So, income statement of sole traders in trading activities. So, what is income statement? It is a statement to show the profit for the year. Okay. See here. This is a format of income statement. So, what is the format of income statement? So, this is the format. Revenue. We have to show revenue. So, that is sales less sales returns. Then we have to show cost of sales, opening inventory. So basically, you have to learn this by heart. Means you have to know how to write it. So you cannot write it in a haphazard way. However you write. So this is known as format. So you have to learn this format strictly. So all the headings are very important. See, you have to write the trader's name, whose income statement is it, and income statement for the year, which particular period you are recording the statement. So particulars and the currency, whether it is in dollars, yen, or the pounds or whatever. So then you have to write it in this detailed order. This requirement is as per the standards. This you have to show, because if different people write different accounts in their own way, then users of accounts, like any person who is who is interested in investing in a business, may not be able to identify. So he may not be able to easily find out. So then he may have to do some lot of things may be required. So that is why we have to follow everyone. They have to follow certain rules, and they have to follow the particular order. The particular order they have to follow. So this is the order, and this is known as format. Format means you have to write it in this way only. So you are not supposed to write it in any other. So what are the different items that are there in income statement? Revenue will come, sales return will come. So then there is something known as cost of sales. What is cost of sales? Opening inventory, purchases plus purchase returns. Then if you have taken out any goods for own use, that one you have to subtract. Then you have to add carriage inwards. Carriage inwards means in amount spent on getting the goods inside the premises. So less closing inventory. So the inventory of goods that you have at the end of the particular period. So that will give you cost of sales. Then that will give, so revenue minus cost of sales will give you gross profit. To that you have to add other income like discount received, rent or interest received. So from that again you have to take out all the expenses like wages and salaries, rent and rates, total. So that will give total expenses. So if you deduct, then that will give you profit for them. So that will give profit for them. So you have to learn all these things. So strictly you have to learn these items. Okay, so to simplify, what I have done is, so learn it in this way. So first step is revenue. See, what is revenue? Revenue can be sales, it can be sales minus sales returns, so you can show directly, you can show revenue, but it is interchangeably used. Sales and revenue are interchangeably used. Sometimes in the questions revenue will come, sometimes in the question sales will come, sometimes they will just say sales and sales returns. Revenue, the word revenue itself will not come. Sometimes they will give revenue also and sales return also. So you should not get confused. Revenue is often interchanged with sales, and revenue is nothing but sales minus sales return. So revenue as such, only if sales are there, no returns are there, then it is equal to sales. So this is very important. So first to know this, because some questions they say revenue, some questions they say sales, some questions will have sales minus sales returns also. Sometimes they will give revenue also, sales return also. Sometimes they give sales also, sales return also. So don't get confused. So the first step is revenue. You have to find out what is revenue. So sales minus sales return. So or revenue minus sales returns. First, that is the first step you have to write. What is the second step? The second step is cost of sales. So you have to remember cost of sales. This is particular heading, this is a particular heading, you have to be aware and you have to learn this behind. So what is there in cost of sales? Cost of sales, you will have opening inventory plus purchases less purchase returns plus carriage inward minus closing inventory. So all this put together is nothing but cost of sales. So when you say cost of sales, it is nothing but opening inventory plus purchases minus purchase returns plus carriage inward minus closing inventory. So that is cost of sales. First step is revenue, learn revenue. Second step is cost of sales, learn cost of sales. Third step. So this will give you, once you get this, you get gross profit. So you get gross profit. So don't forget to write gross profit. So it is just, this is nothing but revenue minus cost of sales. So that is what is gross profit. Simple. Okay. So gross profit is nothing but revenue minus cost of sales. Then what you get is gross profit. Now what you have to do, fourth step, you have to add other income. Remember the fourth step, other income. So what is other income? Other income is other than operating income. So what is operating income? Sales is operating income. That is the main source of revenue. Main source of revenue to the business. So that is what is revenue. Operations, income from operations. So what is other income? Other income is subsidiary income. So which is ancillary. So maybe you have received some interest receivable. So you might have received some interest receivable. You might have received some discount received. So similar to this. So these are not, this is something which you have got not in the course of business, but it is ancillary, it is additional subsidiary income. So that's why you have to show it separately. That is the rule. You have to show the people who are leaving your business income statement, they should identify what is the revenue from operations, what is the revenue from other income. So all those things you have to they have to know. That's why we have to prepare this. So it is a rule to present it in this format. So then what is the fifth step? The fifth step is you have to take out overhead expenses. So what are the overhead expenses? Overhead expenses may be rent paid, rent payable, salaries, printing and stationery. This may include even depreciation. Depreciation charge, depreciation. So all those things. So these are the expenses which are not incurred for the purpose of making the goods ready for sale. These are after expenses. So you have to remember this one. So that will give you, after doing this 6.6, you will get profit for this. So simple it is. Just you have to remember what are the things you have to remember. Just learn it in this way. Number one, revenue. Number two, cost of sales. Revenue minus net sales. Cost of sales. Third step gives you gross profit. Fourth step, other income. Fifth step, other expenses, overhead expenses. So then sixth one is what you get is ultimately profit for this. So remember this as income statement in 5 steps. Just learn this by heart. So income statement you can find lot of times, couple of times having been asked, so many times. So lot of questions have been asked on income statement, and they're easy marks in AS level, A level and AS level also. Lot of questions have been asked. So going forward, you will have to prepare income statement with adjustments. So what are those adjustments? Adjustments are depreciation of non-current assets, accruals and prepayments, irrecoverable debts, irrecoverable debts, and provision for irrecoverable debts. So and a lot of other adjustments will be there, and often, very often, questions are asked on income statement. So you have to be very thorough in this aspect. So it is easy marks. So remember it, learn it back to as so be proactive. So work hard from the day one so that you get very good marks. So in the next class, we will start with problems on income statement. So till then, have a good day. Hello, dear students. Welcome to Shasa's virtual classroom. So today we will do a recap of whatever we have learned till now. So basically this is a recap session. So in this lesson we will discuss what all we have done till now. So the first lesson was cash transactions. So in this lesson we learned how to record cash transactions when payments are made and amounts are received. When amounts are received in received and paid. So that is what is cash transaction. Cash transaction means money is paid to someone and money is received from someone. So how to pass those entries? So that's all we have done. So here in this we have learned all about personal transactions, like when we receive money from accounts, personal accounts, how to record them. So when someone gives money and someone receives money, how to record it. And we have even learned how to record expenses, how to record when payment is being made or received. So all these things we have learned in cash transaction. In lesson number 2, we learned credit transactions. So what are credit transactions? Credit transactions are those where where amounts are not paid, where amounts are not paid or not paid. So or not paid. So that is why it's called credit transaction. The payment is not made instantly, or amount is also not received instantly. So again, how to record when amount is not received, and again when there is a transaction with personal account, when there is a transaction with expense account, income account, and all other stuff. So we have learned in credit transactions. How to record credit transactions? We have learned in second lesson. So we have done couple of questions. So here also we have done couple of questions. In this also we have done couple of questions. We have discussed a couple of questions. Please go through that. And then again, third, we have learned books of time entry. We have learned about books of time entry. So what are the books of time entry? Sales journal, sales journal, purchase journal, sales return journal, purchase return journal, cash book, general journal, or just journal. Okay, so what is recorded in sales journal? All sales, all particularly all details of sales, particularly credit sales, are entered in sales journal. Purchase journal, all credit purchases are recorded. Sales return journal returns when customer returns the goods. Then whatever entries we make, so that is made in sales return journal. Purchase return journal, we record the purchases, we reject the material and when it is given back. So that is what is purchase return journal. So that is written in purchase return journal. So in cash book we record amounts received and paid, whether cash or check. Okay. So cash or check. And even discount column also we have learned. Discount column, how to write discount column. So we have learned how to record entries in sales journal, purchase journal, sales return journal, sales return journal, purchase return journal, cash book, general journal or journal. So what do we enter in general journal? Adjustment entries like outstanding expenses, prepaid expenses. So purchase of non-current assets, purchase of machinery, purchase of how to rectify entries. So for a non-current asset, entries related to non-current assets, rectification entries. So basically, what all doesn't come, what doesn't come in sales journal, purchase journal, sales return journal, purchase return journal, cash book. So that will be reflected in general journal or journal. So that is how it is. So we have learned how to write this and all. So then how to post it to the ledger also we have learned how to post to ledger. And again we have learned division of classification of accounts, division or classification of ledger accounts. Ledgers also we have learned. And so in ledger we have learned how to post, how to prepare. All these things we have learned in ledger accounts. So then division or classification of ledgers. So what is the purpose? How many different classifications are there? So all those things we have learned. And we have learned the balancing of ledger accounts. Balancing of ledger account. So that is how to uh, do the balancing of ledger accounts. And we have done one comprehensive problem also. Comprehensive problem to cover up all these aspects, and we have prepared, ultimately we have prepared trial balance. So how to prepare trial balance? Prepare trial balance. What is trial balance? How to prepare trial balance? The format of trial balance, the procedure, the structure or the design of trial balance. All these things we have learned. Uh, all this, whatever is there, whatever we have learned, all this is known as bookkeeping. So all this is known as bookkeeping. So till the preparation of trial balance, the work is done by bookkeeper or clerk. So after this, the next step starts. So the next step is known as financial accounting. So the accountant does the financial accounting job. So he starts with financial accounting. So next lesson. So here onwards we will be doing financial accounting lessons, like how to prepare income statement, how to prepare balance sheet, what are the differences. So the main accounts here till here was all basic, but very very important for you to get understanding of accountancy. So now from the next lesson onwards, we will start financial accounting. Till then, bye bye.
Dear friends, welcome to Shasha's virtual classroom. So today we'll be discussing books of prime entry. Prime means first, initially. So as soon as a transaction happens, we record it someplace. So what are the different types of transactions they happen? So we sell goods, so they are known as sales. And when goods are returned, when sold goods are returned, they are known as sales return. We purchase goods, it's known as purchases. If the goods are not of good quality, we may return the goods, purchase return. Business even receives and pays cash, even that is recorded. So apart from that, there are a lot of other things which are recorded. So when they happen initially, as soon as they happen, we record at one place one books, certain books, okay, certain books. So we don't write in haphazard way, we write in certain books. All sales, we record in sales day book or sales register or sales day book. It is also known as sales day book. Similarly, some customers may return the goods, so we record them in sales return register. So when purchases are made, all the purchases are recorded in purchase register. Similarly, if the goods are not of good quality, we may return the goods, so they are recorded in purchase return register. So when amounts are received and paid, receives and pays, when business receives and pays, so it is recorded. So they are recorded in cash. So summary of receipts and payments, whether cash and bank. It is if you receive by check. So all those will be recorded in cash. So a lot of other entries like purchase of non-current assets. Because purchase of non-current assets are not purchases, right? So it will not come. So purchase of non-current assets. Adjustment entries. All these entries are recorded in a book called General Journal. General or Journal. So we have to write the specific transactions in specific book itself. We cannot mess up. So the entries cannot be messed up. Okay, so this is the fundamental rule. So in this lesson, we will learn how to record the entries in the books of prime entry. So how will be the books of prime entry? So you can see the books of prime entry will be like this. So the dates will be there, particulars will be there. So date means date, particulars means party's name will be there, from whom, to whom we have sold. So obviously customers, name, date will be there, customer's name will be there. Everything will be entered in sales return. So sales return journal, again customer's name will be recorded. So again date, particulars. So particulars, customer's name will be recorded and amount also will be recorded. Similarly, in purchases journal, we record supplier's name. suppliers name and details of what is the amount of transaction of this. So again, purchase return journal also we record suppliers details. So obviously date will be there. All those things will be mentioned. So this is how the entries we have to enter. So in this specific format, specific what do we say? Order itself we have to write. So we have to write specifically like this. So this is a list. Actually, these are the list: sales journal, sales return journal, purchase return journal, and purchase journal. These are all lists. Okay, so these are all lists. Lists of list of sales return, list of sales purchases, list of purchase return. So everything will be there. So from here, once we write here, so what happens next? So sales return, sales. What happens? There are two things. One is sales and one is customers names. Customers ledger. So sales, what we have to do is we have to add all this. Whatever the amount comes, we have to enter in sales count. We have to enter in sales account. So sales journal is different, sales account is different. Very important. Similarly, sales return journal, whatever the total amount, we have to enter in sales returns account. Total, this total. Total amount. We have to record in sales account. Total amount. We have to record in sales returns. So then, so purchases. So purchases, total purchases will be entered in purchases account. So purchases account. So again here this total amount will be entered in purchase returns account. So this total will be entered. So the supplier's names. So the details of, suppose this is Mr. A, Mr. B, Mr. C, it will be posted to the respective ledger accounts. Let us say here customer, say Z, Y, X. So suppose these are the customers. So we have to transfer, we have to make the entries, corresponding entries in Z's ledger account, Y's ledger account, X's ledger account, V's ledger account respectively. So separately we have to record, but total of sales we have to record to sales account itself. Only one. So aggregate. So aggregate will be recorded in So no individual. Okay, no individual. Should not record individual entries again in sales account. The total of sales journal will be recorded in sales account, whereas customers accounts will be independently recorded in the customers respective customers. The same rule applies for even for sales returns, purchase returns. So remember, sales journal is different, sales account is different, and total amount of sales or sales return, purchases return, only total is recorded in either sales account or sales returns account or purchases account or purchase returns account. Aggregate will be recorded and individual entries will be posted to individual accounts. So then sales register versus sales accounts. So remember, this is very important point. So often asked in MCQs, so you have to be very clear with this. So then similarly, sales register, sales return register versus sales returns account. So both are different. So then cash. So we have discussed the sales register, sales return register, purchases register, purchases return register. So when we receive and pay, we record in cash book. Cash and bank columns will be there. So cash book. So the format is see, cash book we have to record in this way. So cash book will be divided is usually divided into two parts. So debit part and credit part. So in debit part, date, particulars, from whom the cash has been received, folio, ledger folio, number, discount. So there is one column for discount also. So when we receive money, we may allow some discount. So that discount will be recorded here. When we receive cash, we record here. And when we receive checks, we record in bank. Similarly, date, particulars, folio, discount. So when we make the payment, we may receive some discount. So we record the discount here. When we pay by cash, if we pay by cash, we record here. If we pay by check, we write it in bank column. So very important this particular format. So very important question. So often asked in AS level exams. IGCSE also this question is often asked. So cash book very easy marks. So just you have to remember the format and just plug in the figures. So very simple, very easy, but format is very important. You have to write this in this particular way. So it's very important. So it's format oriented. So format is very strictly how to follow the format. Then last, general journal or journal proper adjustment details. So journal. So the format of journal is like this: date, particulars, folio, debit, and credit. So whatever is debited we write here, whatever is credited we write here. So this is also from here we just write it as a for reference. From here we record it for respective ledger accounts, and cash book also we record the entries, and from here we post it to respective ledger. So remember this. So it's a very simple chapter, simple lesson, and but basically to understand accounts you have to do all this. You have to understand all this, otherwise understanding will be incomplete. So we'll wind up. Next class we'll work out one problem based on this. So we'll work out one practice exercise based on this. So 1 or 2 questions will be more than sufficient, because we just need to know how to record it and how to post it. So until then, bye bye.
Statements of cash flow. How to start and finish studying. Have a bird saving of the entire syllabus. Study each topic thoroughly. Work out example illustrations and exercises. Repeat until you understand. Practice exam questions. Practice small details. Simulate exam conditions. And practice. In this lesson, we learn everything about meaning and importance of cash flow statements. How and why are companies required to include a statement of cash flows in their annual accounts? How to prepare a statement of cash flows in accordance with the IGCSE. Altogether, we discuss and practice questions based on these concepts. Identify and practice examination techniques. What is the statement of cash flows? A statement of cash flow is one that keeps the cash flows of a business over a period of time. Usually, the same period as they cover the income statement. The cash flow is any increase or decrease in cash in a business. Cash includes cash in hand and deposits repayable or not as a overall figure payable, repayable or not. For our purpose, deposits and overdraft generally balances and overdraft with banks. The word on demand means either immediately, example, current account or within 24 hours or within notice of repayment. Why statement of cash flow are important? While it is necessary to know how much profit a business will make, profit is not is not cash in the bank. The business does not pay its suppliers the balance of the retailer. Suppliers are paid from the money the bank has in its bank. No business has ever been forced to has been forced to close down its suppliers or trade business because it made an operating loss. But a business can be forced to close down because it has insufficient money in its bank account to pay its debts when they fall due. This is known as being insolvent. The amount by which money the ready money in a business exceeds its immediate liabilities and exceeds its liquidity. There is a big difference between profit and liquidity. A business may make a large profit by finish up with less money in its bank account at the end of its year when it started. For a period of time, business needs to generate cash inflows that at least match its cost cash outflows. Cash inflows include money received from issue of shares or capital put into the business, loan received from banks or other lenders, money received from the sale of surplus non-current assets, payment from customers with state received for goods sold below, interest received on deposits with banks and other companies. Cash outflows include payments to suppliers with state payments or other creditors as already mentioned and the remit of the tariff renewal of and additions to non-current assets, interest on loans and debentures, payment of tax on profits, payment of grants for a suitor or partner, costs involved in the growth of business, expansion and development, dividends payable to shareholders and grants of shareholders and partners, repayment of loans or redemption of shares in a company. Statement of cash flows and limited companies. The International Accounting Standards which cover the structure and layout of the statement of cash flows and company is IAS. This requires that limited companies produce a statement of cash flows as part of the annual financial statements. The statement provides any guidelines for the format of statement of cash flows. This statement is divided into four categories. Operating activities, the main revenue generating activities of the business together with the payment of interest and tax. Investing activities, the acquisition and disposal of long-term assets and other investment activities. Financing activities, receipt from the issue of new shares, payment for the redemption of shares and changes in long-term borrowings. Reconciliation of the opening cash and cash equivalents at the start of the period with the closing cash and cash equivalents at the end of the period. As a result of the net cash is now out of the period. At the end of the statement, the net increase in cash and cash equivalents is shown, but at the start and end of the period of the review. For this purpose, cash is defined as cash on hand and cash on hand and bank current accounts. As mentioned earlier, cash equivalents are short-term investments that can easily be converted into cash as money held in term deposit account that can be withdrawn within 3 months from the date of deposit. Bank overdraft usually repayable on demand are also included as part of the cash and cash equivalents. Format of the statement, operating activities. The cash flow from operating activities is calculated as profit from operations, profit before deduction of interest and tax, add depreciation charge for the year, add loss on sale of non-current assets, or deduct gain on sale of non-current assets, add or deduct changes in inventory, stable inventory levels, less interest paid, less taxes. The figure calculated now has to be adjusted for the following items. Depreciation charge for the year. This is adjusted by adding to the profit for the from the operations figure. The reason for this is that depreciation is non-cash expense. More money enters or leaves the business for depreciation. The effect of the depreciation charge was therefore to reduce the profit, but not the cash generated from the return operations of the business. Loss on sale, disposal of non-current assets, and profit on sale of non-current assets. If it is a loss, then it is to add it back to the profit from operations. The reason for this is that the loss on sale of non-current assets is not a cash generated or paid charge. If it is a profit on disposal, then it is deducted from the figure for the profit from operations. Again, it is not the actual cash generated from the non-current assets. The effect of the profit is to reduce profit from operations. Changes in inventories, trade, and other receivables or payables. These to be treated as the addition or reduction to the profit from operations. To work out whether the adjustment is positive or negative, it is necessary to compare the value of the inventory, trade receipts, and trade payables in the opening statement of financial position with those in the closing statement of financial position. The difference between the two figures is the adjustment to the if the inventory has increased over two periods, then money must have been spent to buy extra inventory. Thus, the difference between the two figures is deducted from profit from operations. If on the other hand inventory has gone down, the money has been saved. This is positive adjustment for the business. If the trade receivables have increased over the two accounting periods, then money has not been collected from them. Thus, the difference between the two figures is deducted from profit from operations. If on the other hand they have gone down, then this is a positive adjustment for the business. If the trade payments have decreased over the two accounting periods, then money has been spent paying them. In this case, the difference between the two figures is deducted from profit from operations. If on the other hand they have increased, then this is positive adjustment for the business. Interest paid, which also has to be deducted. Taxes paid on income, usually corporation tax. Taking all these items into account when preparing the statement of cash flow, the section on cash flows from operating activities will look like this. Investing activities. This is calculated by including inflows from proceeds of from sale of non-current assets before taxable and taxable together with long-term non-current assets. Outflow from cash used to purchase or non-current assets both taxable together with other long-term non-current assets. Interest received, dividend received. Financing activities. This is calculated by including inflow from cash received from the issue of share capital, raising or increasing funds, outflow from repayment of share capital, repayment of loans and finance liabilities, dividends paid. Reconciliation of cash and cash equivalents. Net equities or decrease in cash and cash equivalents for the year. Cash and cash equivalents is reduced for the year. Cash and cash equivalents is done by the year. Set out below is full statement of cash flows from the taking all the above into form. So this is how a statement of cash flow will appear. So it will start from operating activities. So it will start from profit from operations before tax and interest. So this is the starting point. Profit from operations before interest and before tax and interest. So that we have to add adjustments for we have to add or deduct whatever. So depreciation charge for the year will be added. Increase in inventories will be subtracted. Decrease in trade receipts will be added. Increase in trade payables will be added. So that will be cash use your cash flow from operations. Interest paid during the year, tax paid during the year, that will be net cash used in or from operating activities. Cash flow from investing activities. So that this is the second part in this. So purchase of non-current assets, profit from sale of non-current assets, interest received, dividend received. So all these here have a link has an access with investing activities. So that's why they are then next that will give net cash using or from investing activities. So then the next one is Cash flow from financing activities. Proceeds from issue of share capital, repayment of long-term borrowings, dividend paid. So all these will be either added or subtracted. So that will give you cash used in operating financing activity or cash flow from financing activities. So if you add all the three, this one, and this one, that is cash flow from operating activities, cash flow from investing activities, cash flow from financing activities, the net amount will be net cash used in net increase or decrease in cash and cash equivalent. So to that, when you add cash and cash equivalents at the beginning of the year, that will be cash and cash equivalents at the end of the year. So this and this will be appearing in the balance sheet. This amount is the amount which you get after you work out all this adjustments. So whatever. So when you do all this, you get this figure 81,000. So this is from the how to prepare a statement of cash flow from statement of financial position. Statement of cash flows are prepared by comparing the amount for items in the latest statement of financial position with the amount for the same items in the previous year's statement of financial position. Some additional calculations for non-current asset required. The following example is the explanation of the procedure. The statement prepared as a third below. Prepare working. The following information is required will probably not be used. Non-current assets, cash paid for assets or received to sale of good assets. Amount provided for depreciation and income statement. Profit and losses in the disposal of non-current assets. Dividend, interest and taxation. This information is best discovered when preparing roughly accounts as the workings and calculating the information as balance. Second step, once all the workings are done, the statement can now be prepared. Step 2. Prepare a statement of cash flow for the year or the year ended for the year ended, whichever. So net cash flow from operating activities, there is no difference. This is no different to the process described in this video. Start with the formula for operation tax, then adjust for non-cash items in the income statement. This is those items which do not involve the movement of cash such as depreciation and profit or loss or disposal of non-cash. This figure will come from earlier work. Increase or decreases in state receivables and payments. This is done by comparing the figures for each of the two statements of current. Remember that if the inventory has increased in the previous, then the company must have spent cash acquiring the extra inventory. This means that it will have negative effect on the cash flow and will appear in the bracket. Likewise, if the trade receivables have increased in the previous, this means that the company has not received cash from its customers. This too will have a negative effect on the statement, the cash flow of the company, and will appear in the brackets in the statement. If, on the other hand, the trade payables have increased between the years, then the company will have saved its cash by not paying its employer. In this case, the change will not appear in brackets in the statement, but the cash flow will have benefited from this action. If these situations are reversed, then treat them opposite to their own interest. Interest payment take care it as it may be that the loan was taken out partway through the year. Alternative, perhaps not all the interest will have been paid during the year. Check the closing statement of financial position to see if there is any accuracy in the tax paid during the year. This will come from the working. So, familiarize yourself with the workings, for example. Check whether all the figures come from and how they are calculated. All non-cash items in the statement make sure understand the effect of changes in the part to identify the items which form the cash flow from activities purchase and sale of non-current assets. Part so then part B, identify the cash flow from financing activities. So these cash flows from the from loans and returns. Learn the format of the statement and which items go where under which heading. Don't worry when you get to the end if it doesn't help. Set the figures for cash and cash equivalents. The star and prepare the statement of cash flow note. Leave plenty of space to margins for details. Start by filling in the items in the statement to purchase of non-current assets. This is a disposal of insurance movements in future destination. Then proceed to the items. Advantages of reducing the statement of cash flow. The statement of cash flow is an extremely useful addition to the annual account. The advantages to business reducing the cash. It shows the amount of tax for the year. It also allows the business to generate cash. The ability to generate cash in cash flow is easier for a non-accounting person to understand. We all look closely at our cash and bank statements. It is easier to understand that the income statement and statement of which rely on technical knowledge and applied using accounting which do not apply to cash. Suppliers are more interested in together when how much profit it makes. Remember, cash and profit are different. It provides useful links as a backup to the income statement. The only real disadvantage of producing a statement is that it ignores the national plan. This means that the cash contribution order going out may relate to a previous planning period. However, the advantages of producing statements are far more beneficial to the business. It allows another element to assess the overall performance.